everyone. Good morning. So, less students in the class. I don't know where are others. Okay, so let's get started. I don't, whenever the others will join, they will join. Let's start it. Let's not waste the time. Okay. Now, today we will be starting from accrual accounting. Good morning, Amandeep. Okay, so what is accrual accounting? You might have already heard about accrual accounting. Any one of you know what is accrual accounting?
The transaction is recorded when it is actually happened in the business and not when the cash is received.
Go. So, accurate accounting means a method of accounting where revenue and expenses are recorded when they are earned or incurred, regardless of their cash transactions. So, let's take an example. Just a second. Okay, let's start. Accurate. Now, see. Accrual accounting means, like we have already mentioned, that this is an accounting where your expenses and revenue are recorded when they are incurred, irrespective of their cash transaction. What can be an example? Let's suppose, let's take an example that there is any company XYZ, okay, which has provided a service on, let's suppose, on 30th December 2023. Now, see, transaction has happened on 30th December 2023, but client has paid on in Fab. So when they will record this accounting entry? In December or in Fab?
December.
Yes, it will be recording in December. That is your accrual accounting. Means revenue and expenses when they incur, regardless of cash. Clear? Now let's start next. Going concern. Now, what is going concern? I don't think so. I even need to tell. Still, going concern means it is an accounting principle that we all estimates that your business is going to be continue for the unforeseeable future. Unforeseeable future means you are not going to shut down your business for next 12 months or anywhere in future. Clear?
Yes, ma'am.
Yes, clear.
Okay. Next is attributables of useful information. There are two attributables of useful information. One is relevance, other one is faithful representation. First of all, now what is this relevance? If I talk about relevance, what is relevance? Anyone of you aware? Relevance here means is relevant information. Let's take an example. Let's suppose you guys are writing FR paper and I start teaching you audit. Is it a relevant information that I will be passing you? No. Or you can take an example. Let's suppose your manager asked you for a report of cash transaction and you have provided him a credit transaction. So uh, definitely the information that you have provided is not relevant. Got it? One more thing is more, sometimes due to sometimes due to irrelevant transaction, that has a material effect over your financial statements. When I say material effect, it means that your misstatement, I cannot say misstatement here, you can say whatever the information you get is reflecting a bad impact over your financial statement. How in bad impact? Let's suppose your assets value was to be due to irrelevant information. Let's suppose according to relevant information, your asset value need to be 2 lakh, but it become 2.5 lakh, of 50,000 rupees extra. Definitely, it is overstating your assets. That is material effect. Clear or no?
Clear.
Yeah.
Yeah.
Okay, Ritika is not clear. Ritika, see what happens is relevance means, first of all, here relevant information, that whatever the information is important for you, that should be with you on time. For example, let's suppose you were doing the calculations of assets to be recorded in the financial statements. Now you were not aware that there were one asset that was disposed of, and you have, instead of 2 lakh, you have recorded 2.5 lakh assets in the financial statements. Now what will happen? Due to this 50,000 rupees impact, your assets are overstated. That is the material effect in the financial statements. Clear? Okay. Now, next thing is faithful representation. Faithful representation means whatever the information that you are presenting, it should have a completeness into it. It should have an accuracy. For example, I am saying, okay, you know one thing, general entry has always two impact. If I am saying, you have sold goods to Ram, now you know, if nothing for cash or something has happened, let's suppose it is a credit transaction, you will say, what you will say, Ram account debit to sales account. Correct. If I just tell you to record the sales, will it be a complete information? How will you know whether it was a credit transaction, it was a cash transaction? How will you be able to record your entire amount or a complete information? So that information cannot be a faithful representation. So any information that needs to be faithful should be complete. Complete means I have provided you entire complete information. For example, now let's take an example of a class only. Let's suppose I was solving IFRS 15 questions and I have just taught you steps. I haven't taught you how to finalize the transaction, how to do the journal entry. Then what is this? I haven't provided you all the relevant information, all the complete information. Second thing that you have in faithful representation is accuracy. Now, what is this accuracy? This accuracy means that your information should be free from errors and omissions. When I say error, now you know one thing, we all are humans, correct? Whenever we are making financial statements, there are chances that, for example, there was any balance that was 636. You recorded 663. That is a mistake that sometimes can happen with us, right? So accuracy means whatever you have recorded your transaction, that should be free from errors. Omission means you forget to even record a transaction. Now the third point that you have is neutrality. Neutrality means your information should be free from biasness. When I say biasness, is simply, now let's suppose okay, let's suppose Aryan has a very good terms with his creditors. Or, okay, now what Aryan did is, let's suppose Aryan has a very good terms with his creditor or customer. Aryan has provided over one customer very discounted price and he has given the insider information. That is not neutrality. You are making a biasness of the information available. Sometimes being very close to the organization, you might have access to the information that not a general person have, right? And if you're trying to make a misuse over it, that will become a biasness. Any doubts still here? Anybody has any doubt?
No,
No,
ma'am.
clear.
Okay. Now, my question from first of all, before I explain this completeness, these above point, can anyone tell me what is prudence concept? You might have already studied about it. Prudence is also known as conservative principle.
I'm recording all the expenses and like recording all the expenses and providing for the losses.
Yeah. Okay. Okay. I would say that prudence concept. Yeah, very good. Umair has written not over or understating of revenue and expenses. Absolutely correct, Kanika also. So what is this is nothing. This is a principle which states that your assets and income should not be overstated and your liabilities and expenses should not be understated. Now see what happens. We are talking about prudence. Which say do not overstate assets understate the expenses and liabilities. Now, you know one thing what happens in every business is now see, let's suppose you are doing an inventory valuation. Okay, let's suppose you were required to do an inventory valuation. Example, you were doing an inventory valuation. Let's suppose let's take an example. There is an industry which is into fashion, especially let's suppose they make women clothes for the women clothes, and you know very well that in the fashion industry the risk is the very high because customer taste and preferences changes very quickly. Even if you see fashion, daily new things come into the market, daily old fashion goes out. Correct. Now, so what thing happens in inventory valuation? Let's suppose your stock was for $10,000. Now, that stock has become obsolete. Stock has become obsolete and that can be sold maximum for $4,000. Which amount you will record in your books? 10,000 or 4,000?
We need to record 4,000.
Correct, 4,000. You will write off 6,000 inventories. That is what your prudence says. That whenever you are recording any transaction, make sure you are not overstating or understating it. Clear?
Yes.
Okay. Now let's talk about we were talking about your characteristics. Fundamental characteristics were relevance and faithful information. Now let's talk about enhancing qualitative characteristics. The first one is comparability. Comparability means simply that whatever the information you have, you are able to compare it. For example, let's suppose there is any ABC company, okay, and which wants to let's suppose which want to check their last 5 years performance. They want to compare their last 5 years performance. Now tell me one thing, if We have already talked about these things yesterday as well, that every company needs to ensure they are consistent with their policies. If they are not consistent with the policies, definitely, will you be able to make last 5 years performance analysis report? No.
No, not
Every
possible.
time there will be different accounting policies they have used. You yourself become so confused, and it will be uh, for sure very complex thing, and the comparison will also not be easy. And this is not with only company. Now just imagine there is any industry. Let's talk about textile industry. In textile industry only there are n number of companies, correct? Now in n number of companies, if I ask you to prepare a report for 5 top companies and compare their performance, if there is no consistency in the accounting principles, if there is no consistency over the your IFRS standards, IAS standards, definitely it is next to impossible to make a comparison report. That is why it is very important to make sure that your whatever the information you are using, that you can compare with other performance or your performance from last year. Clear? Yeah, interform and intraform comparison ensure. Next is verifiability. What is this? Who will explain me? Verification part.
Every recorded transactions must be supported by some like document, like receipts and all. Like if we record any income, it should be supported by some or the other type of receipt or like that.
Definitely, that is the thing. Very good. Now, see one thing. If I give you a very layman example, if let's suppose I am saying that I'm an ACC. If I provide you my ID number, can you not check it over the portal? You can check now. If I provide you my name and everything, that can. And let me tell you, many companies ask for your number, your ACC affiliate number, member number. Why they ask you? They ask you, the reason is very clear, so that they can check over the portal whether you are providing the true information or not. Because nowadays it's very easy that you can edit the PDFs, you can edit the certificate. That's not become a very big case. That's become very quick things to do a fraud over it. Right. So what is this? This is also verification. Same way, whatever the information you have provided, that can be verified. Verified. Now, let's suppose I am saying that I have a customer who purchased goods worth $10,000 from me. Now, can I not verify it from him? You can. That is verification. Clear?
Yeah, through invoices we can verify that.
I'm sorry, Abhishek. Can you please come again?
Sorry. I mean, for example, if there is a sale of 10,000, then we can verify it from the invoices.
Yeah, you can see sometimes what happens. Your company can form a dummy invoice. Right. And why company will do that? If they are overstating their revenue, the simple terms will be they are either going for IPO so that they can attract the investor. They are trying to overcase their performance. So in this case, the excess, if you wanted to do a very good verification, that will be from the customer itself. Right. You can trace your cash book as well to know whether you have received any payment from such customer account. These things can happen. These verification, these things you will study in your audit and assurance.
Sure, sure.
Next is timeliness. Now, timeliness means is your information should be available with you on time. Let's suppose you are writing exam tomorrow and you are getting your exam docket day after tomorrow. What you will do with it? You need it before it or after the exam? Definitely before the exam. That is timeliness. That your information should be available with you on time, not after the time. The last point is understandable. That is very, very clear that whatever the information that you are presenting, it should be understandable. It's not like whatever you are speaking, whatever you have mentioned in the report, that none of any stakeholders is able to understand. Now, anyone of have any doubts in actuarial accounting, going concern, useful information, anything you have? Other than Ritika, no one is in the class.
Hello, am I audible?
Yes, yes. Abhishek, please
Uh,
go ahead.
yeah, for the faithful representation, we should have three criteria. First one is regarding completeness, that all the info should be complete. Yeah, like you gave an example of a JE entry of sales to RAM. Apart from that, for the neutrality, you said that the transaction should be recorded without any biasness.
Correct. See, I will tell you one thing. Whenever we are talking about your faithful representation, that is very clear that the whatever the information you have represented, it should be complete. And now tell me one thing: if you don't have the complete information available, you cannot be able to comment over it. You will not be able to assess it. Accuracy means from whatever the source you have, or from your information is free from errors, from omissions. Everything is complete. Ultimately, every point is supporting each other.
Exactly.
Okay. Now, Pooja has first of all doubt that can you, ma'am, give us example of prudence concept? For sure, I can give an example of prudence. Yeah, I will give. Wait a second, guys. I'm taking one by one your doubts from chat box. Now, see, prudence clearly means that you should not overstate your assets and income and understate your expenses and liabilities. For example, sometimes I told you, sometimes companies try to do that so that they can attract the investors. Now, if you're presenting a good information in front of your investor, definitely they will be attracted towards your business. Okay, how many of you watch Shark Tank? Uh, isn't it up in Shark Tank? Every one of you might, and it should be watched by everyone. I would say, even if you don't wanted to watch Indian Shark Tank, go ahead with US one. So in Shark Tank, you might have seen that your sharks always ask for their assets value, inventory values, their revenue figures, and they always ask for net revenue, not gross revenue. Gross revenue means your revenue includes GST part, your returns, everything, and net revenue means free from returns, your GST part and everything. Correct. Now, what does this ultimately means is, if you might have heard about, if you have watched any shark interview over any broadcast, so you might have seen, you might have listened that they mentioned one thing, that whatever the deals are done on Shark Tank set, it is not important that all deals are signed. They always go ahead with the under process of due diligence. Under due diligence, whatever the numbers they have presented about assets, liabilities, everything is checked. Why will company try to overvalue them? So that they can get a shark deal. This is what prudence is. Clear, Pooja? That you are trying to overstate your balances in order to attract the investment or show a better company performance. Now, next question from the chat box is, what is the example of neutrality? This question is by Akshay. Okay. Okay, before that, Akshita has one more doubt, but ma'am, will it impact on taxation part also? See, I will tell you one thing. Companies, even if they are presenting over revenue, they will try to over case their expenses as well. For companies, even if they are incurring 10 rupees expense, that is deducted from the tax part, right? Your depreciation, so many things are deducted from the tax part. So definitely it will impact sometimes text part, but they are still okay. And it's not necessary if they are presenting you the balance sheet, they same way they are presenting to the your, I can say, your tax authority. For private limited, anyways, can you find out anywhere your small startups balance sheet? Can you find out? No. Nowhere you will be able to find out. They can definitely do they can definitely do these errors and everything, and they are very over smart, let me tell you. Now, next question that Akshit has is the example of neutrality. Neutrality means that your information is free from biasness. That what you are providing information in the transparency manner. That whatever the information that you have presented, that is true and fair. Let's suppose I am saying that, okay, that let's suppose I conducted a test, okay, and I have checked honest, let's suppose I have checked honest papers with everyone, and there is any teacher who is doing, let's suppose there is any particular favorite student as they have given the grace marks. That will not, that is biasness. Neutrality means free from biasness. Okay.
So
Any
ma'am,
other
in
question? Yes, Akshit, please go ahead.
so ma'am, in company point of view, there we see that neutrality is there means where at means company point of view in which thought they are saying that yeah, there it is maintained neutrality as per the accounting.
Can you please speak a little bit loud?
Ma'am, I wanted to ask that in the company point of view, where it is utilities there means reporting time, where should be the utilities there?
Okay, yeah. Allow me a second. Let me turn off the fan. I think that's why I'm unable to hear and I haven't plugged in my earphone. Or you can either write it in the chat box, honestly. Do one thing, Akshit, please write it in the chat box. Meanwhile, I am picking other one doubt that was Varsha doubt about accrual accounting. Okay. Now, see, Varsha, what is accrual accounting? In accrual accounting, you say that you record your revenue and expenses transaction when they are incurred, regardless of your cash transaction. What I mean is, let's suppose, Varsha, y- let's suppose, Varsha, you sold goods to any XYZ person today on 9th of June, and she is going to pay you in the month of November. So you will record your revenue transaction today, not in the month of November. That is what your concept of accrual accounting is. In the same manner, if there is any expense, let's suppose you guys know very well we use credit cards, right? And definitely. So now let's suppose you have purchased something today and you are going to make a payment after a month or 2 months. So that is today's expense, not after 2 months. That is what your accrual accounting says. Clear? Okay, Akshit has a doubt that in company point of view, how neutrality they maintain. See, I will tell you one thing, Akshit. In company's point of view, I will not talk about small startups because what happens ultimately startups, I will not say startups are not company. If that is just 9 people, 10 people, or a very small startup 20-25 persons company, most of the things are in the hand of owner only. If you talk about a big companies having more than 200, like for example in VG Learning itself, there are more than 200, 300 employees. Correct. So now in VG Learning, definitely a single person owner, that is Vinod sir, he himself cannot manage everything. He has given the authority to everyone else. Authority means you might have heard about this thing that a single person should not have every authority to make the decision. Their chances of fraud increases. In the same manner, what can be happen that one person is looking after the payments, one person is looking after making the invoices, one person is looking after like collecting the data and making the bill payments. Matlab, not issuing the invoice but calculating how much you need to pay to any person, right? If like these things happens, then definitely the information whatever they're presenting, they will be free from biasness. No one can do a fraud. Clear? But if you talk about in small companies, so there though no one can like there are chances even in sole proprietor business. Do you think sole proprietor businessman present 100% as a true income? No. They always even try to overstate their expenses, understate their incomes. Why they do this? Because they don't need investments. Got it? Okay. Next topic, substance over legal form. This, yeah, that is the reason audit happens, Rajesh, but no sole proprietor business conducts their audit. My father has a business of from dairy products. He's a sole owner. He never conduct an audit and he has a very good level of business. Still, he never do it. The reason is very clear because 90% of the things lies in his hand. Although 30 people are working, still 95% decision lies in his hand only. He makes the payment, he receives the payments on his hand. He never do make payments part to anyone else. So what is this? This is why sole proprietor businesses, small businesses don't require your audit to be conducted. Got it? Okay, substance over legal form. Who will tell me what is this? RN sole proprietor business can conduct audit if they are very big businesses. Can you think a business having a crore turnover or 2 crore turnover can do a audit? Then no, that will be a very expensive thing. But if your business is having so much, let's suppose, let me give you an example. Okay, I know my father has a business associate. His business is sole proprietor, but they have a turnover of more than 60-70 crores. They are conducting an audit that makes a sense, right? But if a business having a crore to, so they don't conduct audit. The reason is very clear. Audit is a very expensive process. Got it. Now tell me one thing. Even being a sole proprietor business, I can easily do audit for my my father's business, right? Even my brother is a chartered accountant. He can do, right? But still, what happens? No one conduct it. In very rare cases, sole proprietor business conduct their audit, and even if they are doing it, they will have a definitely over than 40-50 crores revenue. Okay. Now let's talk about legal substance over legal form. Some of you have given in the example, legal form don't have values, but their value in money matters. Okay. Means the financial anyone can give me an example and then explain it, because theoretical we anyone can tell me the theory.
Deeksha, I mean, legal form and substance. So, if you start with the legal form, it is like, for example, now, I mean, I have a business of giving autos on, lease. So now I've given autos for 10 drivers who wanna just drive, and they'll be earning, and I'll be getting commission to percentage from that. So that is that I'm owning that auto yet, and I have the ownership of that, but just I'm giving out on rent. That is legal form for a specific period of time that is mentioned. And in substance, it's it's kind of agreement, I mean, where that the other person, the ex person, has purchased that auto from me, I mean, for over next 5 years, I mean, purchasing it on loan basis, that he's paying it on monthly installment something. So once that period comes to an end, or else the saturation point of that period, where the asset would be would be transferred to that person. So that is, I guess, substance.
Good, very good, Pranav. Okay, now let me explain
Ma'am,
you. Yeah,
I guess sale and leaseback is also an example of substance over form.
yeah, correct. Lease and sales back is also example of your substance over form. Absolutely correct. Now see, what is substance over form? If I talk about, Pranav has explained very well. I would say this is your accounting principle in which it reflects economic reality, irrespective of their legal form. Let's take an example. There is any XYZ company that is entering into a lease agreement with any other company. Let's take an example. Please listen it to very carefully, whosoever has not understood. There is ABC company who has entered into a lease agreement with any other XYZ company. Let's say. Okay. Now what is happening? Let's suppose lease is for 5 years. ABC has entered in an agreement with XYZ for a lease with a 5 years. Now, see, ABC is the person who is going to use the machinery for next 5 years, correct? But legally, who is the owner of it? XYZ? Yes or no? Economic form, ABC is enjoying the benefits he is getting by using the machinery, but ownership belongs to XYZ. That is also substance over form. Clear or no?
Ma'am, so
Could
why
you
this
please
thing?
repeat Diksha once more?
One by one, can you please mention again? One by one, please. Don't.
Yeah, I mean, could you please repeat that again? Substance
Yeah,
over form.
definitely. I can repeat again and I will give one more example. Just wait. Now, see, in substance over form, first of all, let's clear this example. There is a company ABC which has entered into a lease agreement with a company XYZ for 5 years. Now, in this situation, your ABC company will have the assets for next 5 years, and that company is going to enjoy the economic benefits. Benefits means from the machinery, whatever the revenue they will be generated, that is going to be by ABC. But ultimately, XYZ is the owner of machinery, yes or no?
Yes.
That is substance over form. You can take a next example. I will give you 2, 3 examples more. Let's talk about our example. Okay. Let's
Yes,
talk
sir.
about an example. You have purchased a car. Okay, but when you purchase the car, you go ahead with a bank loan over it. You have purchased a car and you have purchased a bank loan over it. Now, let's suppose your bank loan was for 5 years. Now, let's suppose you generally know we do 20% down payment if we buy all these things. Okay, I have an example, but ma'am, will rental lease will be charged there? Airlines usually purchase aircraft on lease, yes. So see, these are 20% you have done a down payment. Now 80% you have done an EMI over the 5 years. Now tell me one thing. Ultimately, you are the owner of the car. Ultimately, you are the person who is having the economic substance over the car. Yes or no?
Yes.
But do you know this thing? I will tell you one thing. Whenever you purchase something over EMI or over the bank loan, even if you have got a claim that you have finished off the loans and everything, still you need to transfer certain things. I have seen this with one of my relative. That's why I know it. Otherwise, so my father has always purchased car over 100% payment. So I don't know, and I don't own a car. So I just know this thing that whenever you purchase a car, and if you have a bank loan over it, and you have just let's suppose you have paid 20% amount, even if you are paying the EMI, ultimately you are the person who is having the economic benefits, even if your car is on your name. But anyone has doubt in the chat box? But you know one thing. Tell me one thing. Who will be the legal owner of the car in this
Bank.
situation?
Bank.
You know, bank can seize your car if you're not paying it on time,
Yes.
isn't it? That is also an example of substance over form. Substance over form, in short, means is that whenever you are recognizing anything over anything, that economic benefits can be borne by any other party and legal owner can be any other party. They both can record it. Clear? Akshit has an example. So, ma'am, what is the relevance of substance over legal form? In short, in relevance as it is. I am saying you are saying about relevance. Relevance means relevant information of substance over legal form. Okay, why this thing used by form? What is the advantage? See, tell me one thing. I so say, tell me one thing. See, I will explain one more. Wait a second. So, see, tell me one thing. Even if a company is entering into a substance over form, if they are doing anything in a lease or something, now let's suppose, let's take an example. Akshit, you wanted to open a cafe, and definitely if you go ahead and buy a property, that will cost you a lot. If you wanted to open a cafe, let's suppose in any top metro cities or in top tier 1 cities, right? It will cost you a lot. And in the same manner, if you go ahead with the rental period is generally 11 months. Legal agreement is for 11 months. After 11 months, owner remove you from that place then, because ultimately you will be the person who will be paying for interior designing and everything. And after 11 months, if owner removes you from that place, your entire money will be wasted. In the same manner, if you go ahead with the lease for 10 years or 15 years, people do that. Now you will be having a safety that okay, for 10 years I can use this place, I can enjoy the economic benefits, even though you are not the legal owner over it. So definitely you are into a profit. And let me tell you one thing, if you have 2 crores to pay and you are investing that in a property and blocking your cash flows for your business for next years, you will not be able to bloom your business. And in if you have that 2 crore rupees and you open branches all over, small branches, even if you just spend 50 lakhs over a cafe, and you can open 4 cafes, that will be more benefit for you. And if you are paying rent, that will be ultimately tax deductible now. That will be a part of expense of a business. So anyways, business are always in profit. Now I will tell you one thing. If we compare traditional business from new age businesses, traditional businessmen, even I would say I am from a business family, I have seen my father's mentality as well, still toward it. He says paying rent over it is not beneficial for a business if you can buy a property. And I say if you have a cash flow, you can spend it in your business and over expend your business rather than blocking the cash flow by buying a property, if you just have a limited amount of funds. That is my thinking. So definitely that a business is in profit. Now I can definitely explain it again. Pavlin, see what happens. Substance over form clearly means that you are not a legal owner of anything, but you are enjoying the economic benefit. Let's talk about one thing. Ultimately, if you haven't, let's take Pavlin, you have purchased a car by on a EMI basis. Okay. Now, ultimately, even though you are the registered owner, until and unless you don't clear the EMI, bank will be the legal owner over it. You know this thing. So you are enjoying the economic benefits, but the legal ownership still lies with the bank, because if tomorrow you don't pay back the loan or you don't pay your EMI on time, your bank can easily seize your car. Correct. That is what substance over forms. Clear? This I have already explained. Okay. Now let's talk about cost constraint. Now you know one thing. Okay. How many of you know that whenever you try to find out a good information, for that you need to pay? Let's talk about let's talk about physics wala. Nowadays, physics wala is very famous for NEET coaching and everything. Now, uh, don't you think so? Physics wala invest a lot in marketing. And definitely they need to. They are earning a lot. Even if they are spending, that doesn't make that's okay. But let's suppose if there is any business who is just started with their like, suppose they are just started and they are just trying to compete with the physics wala. Now what will happen if that business also try to let's suppose that business is also spending 1 CR in marketing, and they are unable to even generate that much revenue, then what is happening? Your cost is exceeding the benefits. So what cost constraints say that whenever you are trying to find out information, it should not exceed the benefits over it. Clear or no? Let me repeat again.
Yeah.
A simple thing is if you are spending 100 rupees and you are getting the information of just 10 rupees, you should not do it. If you're spending 100 rupees, you should at least get an information of 110 rupees. That is what cost constraint is. Clear?
Clear.
Now, okay. What is asset? What is liability, equity, income, and expenses? Let me ask you only. Let me pick up persons who don't speak in the class from them. Let's see whether they are present or not. Hi, Brindu. And this iPhone person, please rename yourself. Brindu, can you explain us what is asset?
Can you hear me? Hello?
I'm talking about yeah.
Can you hear me? Hello?
Even if you're speaking something, Brindu, I think you are on mute. Brindu, you are on mute. You need to unmute yourself. Then you need to go ahead. Please go ahead.
Ma'am,
Yes.
can you hear me?
Yeah. I think Brindu, you can write in the chat box. That will be more better. Okay. Meanwhile, Brindu's okay. We should discuss. Let's not wait time it. Let me explain you only in single line. What is asset? Asset means nothing. Asset can is divided. Asset means present economic resources controlled by the entity from the past events. Your asset is the part of, like, for example, you have machinery, you have trade receivables, you have cash, you have investment. Everything is a part of asset. On liability. Liability means you need to pay someone in the future due to some event that arise in the past. That can be your bank loan, that can be your creditors. You might be required to pay anyone. Then equity. Equity means shareholders' interest in the business once all the liabilities are subtracted from your assets. And equity has a part of, definitely reserves are also part of equity only. Shareholders fund. Okay, Akshit has a doubt. Ma'am, leased machine will be asset. Yes, you record it as an asset. Okay, let me tell you, we will be studying one chapter known as leases. That is your IFRS 16. I think next weekend for sure we will be able to reach till there. In leases, you will be understanding that yes, even though although you have a lease, you still recognize that as an asset in your book, and over the lease life, you amortize it. Amortize means you clearly charge a depreciation over it. If you have a lease for 5 years, you will recognize that as an asset, and over 5 years, you will charge a depreciation. You will study about it. Okay. Income. Income means anything from where business is coming, your revenue. Revenue can be, a business can have a one revenue source, a business can have multiple revenue sources. You will be studying this lessee next week, Prithvi. I don't think so. I should start today. That will be, I am mixing up every topic. If you are leaser, what you do, if you are there are two words that you use. One is lesser, one is lessee. Whatever you will be doing, I will tell you when we will start this chapter. You need to have patience. Okay. Income means anything from where your business is earning a revenue, right? It can be, now you know very well that a business can have one revenue source or a multiple revenue source. Let's take an example of any edtech company. Edtech company can have revenue sources from live classes, from recording lectures. Correct. One live online classes, one live offline classes, one recorded lectures. These can be income sources. And income sources cannot be from one courses. It can be from multiple courses. Expenses means anything that ever the business is incurring. Even now classes are running, definitely they will be paying me as well. There is a cost of Zoom classes as well, there is a cost of coordinator, everything that is an expense for a business. I don't think so I need to explain that in much detail. Every one of you know it. Any doubts still here before I proceed?
No.
Okay, this chapter is very simple. Next is recognition and derecognition. Now, you know one thing. Let's talk about recognition. Recognition means anything that you are going to present in the financial statement. Let's suppose you have purchased an asset. Now, definitely, if you have purchased an asset, you are going to recognize in the financial statement. Yes or no? And if you have sold any machinery, that you are going to derecognize in the financial statement. Recognition means addition in the financial statements. Derecognition, you can say, the subtraction from the financial statements. Now, let me give an example. Let's suppose you have a business and you have purchased 5 new assets. Okay, let me repeat. Vinod wants me to repeat. Vinod, I am saying there are two words that you use in your business. One is recognition and another one is derecognition. Recognition means a process where you make the addition in the financial statement. Addition, for example, if you have purchased 5 new assets, will you not present them in the financial statements? Definitely, you will write them as assets in the balance sheet. Correct? That is recognition. In the same manner, if you have, let's suppose you were having 10 assets and out of which 2 assets you have sold. So definitely you need to derecognize them from the financial statements. That is recognition and derecognition. Any doubts over it? Okay, I'm assuming there is no doubt. Okay. Now, let's start with the measurement basis. Now, you know one thing. In the measurement, the first thing that comes is historical cost. When I say historical cost, it means purchase cost. Now, let's take an example. You know, guys, two-wheelers. Earlier, when I remember, your scooty. Let's take an example of two-wheeler, your scooty, motorcycle, whatever. Let's take an example. 5 years, 6 years back, scooty used to cost you 80,000, 90,000 maximum. I think so, even 80,000 maximum, it used to cost 70 to 80,000. 6 years back, I'm talking. Right. So that becomes a historical cost. If I talk about today's value, or let's take an example of a land. Leave the scooty part. Let's take an example of any land. any land that you have purchased 5 years back that costed you, let's suppose, 10 lakh rupees. Okay. Those 10 lakhs become historical value. If I talk about fair value means today's market price. Definitely, land is a thing that never get depreciated, it always get appreciated. Right. 5 years back, you purchased it at 10 lakh rupees, that becomes your historical cost. Fair value means today's market price. If let's suppose I decided I wanted to sell this land, and today I decided, okay, this land will cost market value is 15 lakh. That becomes fair value. I am repeating again. Historical cost means the cost at which you have purchased any asset or liability. Current value has three things. The first one is fair value. Fair value means the asset or liability that you have purchased in the past, at what price you can sold it today. Clear with the historical cost and fair value? Yeah, for example, gold. Definitely, gold price is touching sky. Don't you think so? It's too much. Next is value in use. Value in use means, for example, you are using any asset or you are using any liability. What is the value in use? Now, let's me take an example and explain you. Remember that historical cost is purchase cost. Then you have fair value. That means current market value. How much price you can get over it. Then you have value in use. Now, value in use means, let's suppose there was any machinery, okay, that you purchased for $1 lakh. Okay. If you go ahead and sold this machinery, means fair value. Definitely the machine will all be depreciated and everything, right? Machinery is something that gets depreciated. Let's suppose its fair value, if you sold today in market, used machinery, is $25,000. And you are using it. Value in use means you are using that machinery to produce the goods and services. So your value in use can be always different from fair value. It can be more also, it can be less also. It depends upon the situation to situation. Value in use means, in short, whatever the asset or whatever the liability you are using, how much benefits or what is the value they are creating for you. Clear or no?
Ma'am,
Yeah.
so ma'am, how we calculate value in use?
Let me tell you. Okay, let's talk about. Gold will be an example of value in use. Gold. What will be gold? See, gold is generally for an investment purpose, right? In today's era, no one can wear gold and go outside their houses. That's not safe, right? And gold is just for an investment person. You cannot say that is in value in use, honestly. Generally. Now, let's take an example of value in use. Okay. Okay, let's consider there is any ABC company which owns a machinery and they use it in their production process. Let's suppose there is ABC company. ABC company having machinery See, value in use ultimately means that asset or liability you're using in the business. Correct. And gold is nothing that is used in the business, honestly. If that is a gold person, or I can say even a jeweler, that will never be a part of all, honestly, a value in use. That will either fair value or historical value. ABC company having machinery, okay, that they are using in the process of production. In the next 5 years. Now, if I ask you for a calculation part, like Abhishek, I think Abhishek, I don't know who asked me, but someone of you have asked me. Let's suppose the machinery can make an annual cash inflow of 50,000. Let's take an example. Annual cash inflow is $50,000. Okay. And you have estimated that every month, every year, you can say that there will be $10,000 maintenance cost. Okay. So can I say the net cash flow will be $40,000? Can I say it or not? Can I say or no? Correct.
You mean
Up now,
net value in use 40,000?
yeah,
You
that
mean
is
net
what
value?
I'm saying. No, this is not
Okay.
value news. Wait a second. This is not value news. This is just 1 year revenue. This is not value
Okay.
news. Just I have given you an example. Let's suppose there was any machinery that you purchased for 10 lakh dollar. First of all, otherwise values will be very big. Okay. And it has a fair value of, let's suppose, let's suppose $80,000. Means you can, let's suppose you purchased the machinery for 10 lakh dollars years back. Today you can sell it easily at $80,000, and otherwise that machinery will yield you $40,000 for next 5 years. Means how much that is going to yield you? 2 lakh rupees. So which one is greater? Value in use or fair value? Which is greater?
Value in use is greater because it is 2 lakh.
Yeah, definitely value in use is greater. But do you know one thing? You also discount your cash flow due to time value of money to the present value. Present value means, let's suppose I am saying I will be receiving amount 2 years after. And you know there is inflation, there are so many things. Correct? You also discount it. I am not doing the discounting part, but ultimately there will be a discounted rate. You will be doing the discounting part as well. That you will be studying in your FN, financial management. Got it? This is value in use. Clear or no? Any doubts still here? Ritika, are you not clear?
Can you please repeat once again?
Yeah, definitely I can repeat. Why not? See, Ritika, let's suppose you have purchased any machinery for 10 lakh dollar years back, a long year back, and now you are confused whether you should continue using it or you should sell it. Now, if you go ahead in the market to sell the machinery, you can easily get $80,000. Okay. Now you know one thing. You decided, okay, let me compare my fair value with my value in use. Value in use means how much revenue machinery will generate over a year. From the value, you will deduct your maintenance cost and everything. That comes to $40,000. And you know you can use the machinery maximum for next 5 years as well. That means your value in use is 2 lakh. Clear? Yes, Rajesh has written a definition. This means value in use will be the net cash flow by asset over the lifespan of asset. The last one is current cost. Now, what is this current cost? Current cost means the cost of an equivalent asset or consideration that will be received for an equivalent liability at the measurement date. Any one of you know what is current cost?
Ma'am, it will be like net assets, assets
Let
minus
me give an
liability.
example. Let's suppose there is any company who has purchased the machinery 3 years ago for 1 lakh. Okay. Now let's suppose there are certain technology advancement. You know very well. Nowadays technology is definitely advancing a lot. Due to technology advances and everything, you need to replace the machine. Okay. I am saying that there is any company who has purchased any machinery years back for 1 lakh, but now due to technology advancement and everything, you need to replace the machinery with a similar one. Due to just because of technology advancement, your machinery don't have that much advanced technology. Now you need to buy a new machine. Now what is happening? Earlier you have purchased. Let me give an example here. That is current cost. Okay. You purchased any machinery for $1 lakh. Okay. Now, due to technology advancement, you need to purchase a new machinery. You purchased this, let's suppose, 3 years ago. Due to technology advancement, you need to purchase a new machine that will cost you $1,20,000. I am saying that you will be purchasing a new machinery that will cost you $1,20,000. Okay. Now, if I ask you current cost over it, how you will be able to calculate is simply, first of all, over this, let's suppose this machinery useful life was 10 years and you plan to charge depreciation over straight line. If you look at the actual value, that the machinery will have 70,000, yes or no? Carrying value will be 70,000 after 3 years. After 3 years depreciation, carrying value will be $70,000. Now, if I say that you can buy a machinery for 1,20,000, means the value should be $1,20,000, and you can sell. Let's suppose you can sell the asset at $70,000 itself. How much extra you need to pay? $50,000. That becomes your current cost. Means the additional cost that you will incur for technology advancement or due to any other factor, that will be your current cost. Clear or no?
Can you explain again? Mom?
First of all, you will be never you will be okay. First of all, Akshit question, ma'am, in the three of the costs which we will take. So first of all, your current cost, they will ask you in exam either to calculate value in value in use, either to calculate current cost, or either to calculate the fair value is always given. But coming about which one to use, ultimately 90% of the situations in IFRS, IA standard, you will see they always use value in use. Sorry, fair value. Value in use and current cost is just theoretical topic. Even if you want, even if they ask you in exam to calculate it, they will clearly mention it. Duration of class is 4.5 hours and we are just studying from 1 hour. Yes, market value everyone takes. Yes, that will also be included in the current cost version. Okay, let me explain this again. I think some Ashwarya asked me, can I explain it again? Ashwarya, it simply means, let's suppose you have purchased any asset Okay, and that becomes obsolete due to technology advancement. You need to purchase a new machinery to compete in the market. Now whatever will be the carrying value minus the current cost, means whatever will be the value of your technology advanced machinery, that was 1,20,000. 70,000 was the your carrying value of the asset. So 50,000 becomes your current cost. Current cost means the additional cost that you are incurring in upgrading the machinery. Clear or no? Upgradation always means buying a new machinery. Clear? Okay, now they have given what are the advantages and disadvantages of using the historical cost. The first thing is definitely whenever you are using historical cost, that is easy to understand. You don't need to every time use the fair value or other method. That is very simple. Whatever is the purchase price, that is the easy, straightforward thing. Difference between, yes, Rajesh. So your this thing we were talking about historical cost. Yeah. So historical cost is very straightforward to use. Whatever is the purchase price, the same price you need to use as an historical cost. The second thing is definitely reliability. Reliability means definitely you can verify the actual amount from the purchase invoice. There is no chances of anything can be error, fraud, omission, nothing. The third thing is objectivity. No one can manipulate the historical cost. Do you think so? Fair value can be manipulated, yes or no? Okay, tell me. Out of four cost, historical cost, current value, your fair value use, only historical cost is the cost that cannot be manipulated. Otherwise, fair value definitely I can say anything is even its market value is less. I can tell you more if you don't know it, if you're not aware about the standards and everything. Correct. Value in use, again you are saying your machinery will generate a revenue of $50,000. What is the guarantee? Current cost, again that can be manipulated by manipulating your depreciation amount and everything. Company might not be consistent with their policies. Again it can be manipulated. So the advantage is you cannot manipulate it. The third one is, sorry, the fourth one is any doubt, Abhishek?
So we are talking about the advantages and disadvantages of historical cost, which doesn't
Correct.
change over the time.
Correct.
Okay.
Historical cost. The fourth one is, yes, I can repeat reliability. Reliability means in simple, one thing that if you have you are saying that okay, let's suppose Akshita, you told me that I purchased a laptop of 60K 4 years back, and let's suppose, and I'm having a little bit less faith in you, and I wanted to verify whether you are saying true, whether you have purchased the same amount, the laptop on the same amount. I can easily ask you for a bill. I can verify it or no. Verification is easy because you will be having a purchase invoice. Okay, next is conservatism. Conservatism means definitely you cannot overstate prudence. Your prudence concept applies. You are not overstating or understating your asset or liability balance, whatever you have purchased. The last is global acceptance. Definitely, your historical cost is something that promotes consistency. It's not overvaluing the assets, it's not undervaluing the assets. So it is globally accepted. Any doubts and advantages?
No.
Next is disadvantages. Now, in disadvantages, what happens? The first disadvantage is definitely profit reporting mismatch. Now tell me one thing. Let's suppose you are saying, see, this is the principle of prudence only, that you cannot overstate or understate the values. If your historical value, if you are preparing a financial statements according to historical values, definitely you are not overstating or understating the asset or liability value. Got it? Because you are not calculating it at fair value. You are using the historical value concepts. Clear, Divya? Any doubts, Divya? Next is disadvantages. In disadvantage, the first thing that you have profit reporting mismatch. Profit reporting mismatch means is clearly, see, one thing that happens is, one thing, if you are try to use for everything historical values, definitely your profit will mismatch. Why? Anybody would like to tell me?
Yeah, because it is compared with the historical cost. The revenue will be compared with the historical cost.
See, the first example is your historical cost is outdated. Now, if you say something, let's suppose, when my mom and dad got married, my mom always tell me, my father always tell me at that time, gold value for 10 gram used to be 3,000 rupees. Now it's freaking more than 72,000, even 24 carat I'm talking about. Now let's talk about if they have purchased gold at that time and they tell me that its value is just 3,000. How, don't you think so? It's a mismatch thing if they record the same thing in their asset as 3,000. Isn't it? That becomes
Yes,
too
ma'am.
outdated value.
Yes, ma'am.
That's why definitely. The next thing is misrepresentation of economic benefits. Definitely. Now, one thing, you are, let's suppose you are using any land, okay, and I asked you, can you do the comparison? Definitely, if you are comparing it for a historical value, from a historical value, now what will happen over it? It will not represent the true economic condition, will it?
No.
Misrepresentation of economic benefits means simply, let's suppose you have a land is something that gets never depreciated, always appreciated. Now you are using historical values. Historical means the purchase cost, not the actual value. You know one thing very well, that from a then what will happen, that will misinterpret the economic benefits, because I am saying that this land I purchased 10 years ago, 10 lakh rupees, it is yielding me 5 lakhs per month, per annum, almost 50% economic benefit. And the situation can be that the land value has reached to 30 lakhs, then they are yielding you 5 lakhs. So that is not 50% economic benefits over the land value. Yes or no? Clear? Any doubts now?
No. No, ma'am.
Next is lack of separation of holding gain. Now you know one thing. Holding gains, which are gains merely from holding onto assets, are not distinguished from operating gains, potential distorting financial performance indicators. Now what is this? See what happens, you know very well. Okay, how many of you know that if you have gain over your wealth in so much, government tax you.
Yes.
If anyone has a net worth or very good net worth and they are getting capital gains, government tax you,
Yes, ma'am.
inheritance tax, capital gain tax, you know these things. So what happens, let me explain you first of all with an example. Let's suppose, first of all, the lack of separation of holding gains, this is their concept. which says a gain which you arise from holding an asset. Means, for example, let's suppose I will tell you one thing. If any property that your grandfather has purchased for you at his time, and now you have the legacy to hold it, that will have a different gains, yes or no? The value that the value from, let's suppose he purchases for, I will tell you one thing, my grandfather have purchased properties in thousands. Now it's not even in thousand, it's in crores. Definitely the value has gained so much. Correct. So what happens in this? This is holding gain. This is holding gain in the business. Because you are holding that assets, you are getting an appreciation. This is what they are saying. If you are recording historical values, definitely you are not representing holding gains in your business. Got it? And let me tell you, I just represent a situation that you have an asset from last 30 years and you're presenting that over historical value only. You are understating, don't you think so? Your assets are way understated. An
Yes,
example
it is.
apart from a land, definitely there can be an example. Let's consider a company which manufacture and sells electronic appliances. Okay. And they have but generally I would say one thing, you know what, your this gain parts happen in the cases of land only. If you are holding anything else, let's suppose you are holding any electronical gadget, that's value is never going to appreciate. Do you think so its value going to be appreciated?
No, it will not.
I will tell you one thing. When I was small, I was way like I love PlayStation. I still have PlayStation. I used to play a lot of games over this PlayStations. I remember my father purchased the PlayStation for me that freaking costed somewhere around 16,000 or something. That was, I was small at that time. Now a time in 15, 16,000 you can get a lot of things. You know, my father told me when there was no phones, when he got married, there was small phones at that time, you know, Nokia one, that at the time that was just launched. And at the launch time it used to cost around 20 to 25,000. You know, in today's era, in 25,000, paying a 25,000 for a keypad phone in today's era, you can get a very good phone in 25,000. So definitely that is not a holding gain, na? So this holding gains mostly applies in the concept of property on. Clear? Because machinery, all these values starts getting either they, you don't get a holding gains over it. Let's suppose I have a two-wheeler which I purchased 6 years back. Definitely I'm not getting a gain over it. I'm getting a depreciation over it. Next is inflationary impact. Inflationary impact means definitely every year there is an inflation and that leads into the prices. Yes or no? Earlier Maggie used to cost 10 rupees, now it's become 14. It's all because of inflation. Yes. Inflation impacts in the general prices, yes or no?
Yes, it is.
Everywhere. That is inflationary impact. You are not representing it. Any doubt still here anyone is having? Now see, they have given an example of holding an operating gain. An item of inventory was brought a years ago for $10. It could be sold today for 88. So you purchase $10, you can sold it 18, but to replace it, it will cost 15. The profit of 8 is therefore made up for two components. 5 is a holding gain, 10 minus 15. 5 is an holding gain. And if you talk about operating gain, that is 18 minus 15, 3. See, I will tell you one thing. Balance sheet don't showcase historical value. It depends upon companies. 99% of the companies do revaluation. And revaluation surplus is recorded into the other comprehensive income. None of the companies record their values in historical because that is way absurd method. That is very good for a theoretical perspective, but in real life, no one company just follow historical method. Why they will try to showcase their low key performance? Okay, now current value accounting advantages and disadvantages. Advantages is definitely current value means market value, fair value. Definitely the first thing will be relevance. Relevance means it provides you more relevant information to the users that what is the actual value of assets, what is the actual value of liability. Next is inflation adjustment. Definitely every value has the inflation adjustment into it. Because inflation is also necessary. Now tell me one thing. Let's suppose you guys are working and there is, so this is not, sorry, this is not fair value. This is just current value, current cost, one thing. So just imagine a situation, you guys are working, every year there is an inflation and you're not getting increment in your salary. Will you be happy? Know how you will be cope up with the inflation expenses, right? You will not be able to cope up with inflation expenses. If cost is increasing, definitely your income also needs to be increased now. So, now let's talk about disadvantages. The first one is lack of consensus. What is this? There is no single current value, leading to inconsistency and disagreement. What they are saying is, what they mean to say is very clearly that in your current value, you know one thing. Okay, what is current value? Current value means you are replacing the existing asset due to technology advancement or something. So it's not necessary that every company will replace it. If let's suppose there is any industry in which immense amount of technology advancement take place, do you think if out of there are 100 companies, 100 out of 100 companies, 100 of the companies will go ahead with the technology advancement? And even if they go ahead, even let's suppose, even if they, first of all, they will not go ahead, even if they go ahead, their existing purchase price means whatever the assets they have purchased, they will have purchased in different years. Even if you try to compare them, there will be inconsistency and disagreement. For everyone, over every asset, current value will be different. Yes or no? That is what they are trying to say here. That current value that you calculate for every company, for every asset, it might be different due to simple way in which year they have purchased, what is the depreciation policy. So many things matter over there. Next is information available. Now if I say that due to using the technology advancement, you can increase your revenue or you can have a better assets, it's not necessary everyone will have the complete information available. Sometimes value in use might be greater than current value. The revenue or the cash inflow that you are generating might be more in value in use rather than in current value. That can also be a situation. Next is verification challenges. Definitely now it will become again difficult to do the calculation of verification. Comparison will be between the companies will be a conflicting process. Last is complexity. Definitely this process is very complex in terms of calculation and everything. Any doubts over it? You will not get anything to write advantages, disadvantage. You should know just. Okay. Next you have is fair value. IFRS 13 fair value, which indicates that fair value means market price at which you can sell your asset or liability. Got it? Okay, information available one. I can explain. Information available means is clearly that says that, sometimes what happens, in current value, you replace your existing machinery or something due to technology advancement or anything, right? So what happens in information available? Sometimes what happens, someone told you that this technology advancement will increase your revenue. And in actual, it might be a thing that value in use, the current machinery value in use is higher than your um, current value. So these information might not be available. That is a disadvantage. Clear, Pavleen? Okay. Now let me explain you IFRS 13, and please listen it to very carefully. This IFRS 13 is used in every accounting standard except in leases. Now see, I have already mentioned it to you. What is fair value? I have already mentioned it to you. That fair value means market price or market value at which you can sell your asset or liability into the market. Yes or no? Now, one thing that you are saying that okay, that fair value is the price, is the price that you can get while selling your asset or liability in the market. So there are three types of assets. When I say there are three types of market, the first market is active market. The active market means, let's suppose you have any plant and machinery. The same type of assets is available in the market. What will happen in this situation? I am saying that the first thing that happens is an active market. Active market means a market where transaction for the similar amount of asset or liability takes place with a sufficient frequency. Sufficient frequency means with a lot of frequency. Let's suppose, okay, you can talk about, let's take an example of gold. If you have purchased a gold 10 years ago, let's suppose any gold for $100. Let's suppose. If you go into the market and sell it today, you can sell it in active market, yes or no? Because similar type of market exists and there are a lot of transactions happen. That is active market, where you can sell your asset and liability easily in a market where similar types of good exist and their sale and purchase happen in a lot of frequency. Clear or not with active market? Clear. Okay. Now let's suppose you have sold your goods. If active market does not exist for your goods, then in which market you can sell? If there is no active market, then what you try to do? You try to find out a similar products. Let's suppose I am saying you have a machinery or you have anything for which active market doesn't exist, means the similar type of goods not happen, but there is substitute or anything exist in the market. There is no active market. Active market means not 100% identical goods, but a similar type of market exists. Similar means, for example, substitute type of market, something exists. After active market, you sell your goods into that market, and that market you can say is your That market, the first thing that you have is, wait a second. You can say that as the best market for your products. See, the first market that you have is active market where 100% identical goods happens. The next one, you don't have such name to about it. They have just written in the book. Otherwise, just either active market. If you don't have the active market, then you sell into the market where not 100% identical, but substitute or anything similar type of product exists. If there is none of this market or none of the similar type of substitute product exists, in that situation, you try to find out or you try to observe if you sell your goods. The first one is active market where you have 100% identical things. Next, if you don't have 100% identical things, you try to observe the market and try to find out the substitute products and assess the value of your products. If none of the active market happens and none of the observation market happens, then there is a last stage. The last stage will be what you can do in the last stage. In the last stage, you try to find out or you try to assess yourself the value of your asset and liability by looking at the other commodities market. Clear? See, just remember that the first preference for any company is to find out the active market for their product. If they don't get active market, then they look for they do observation. They try to find out the substitute product or a little bit changed product and try to assess the value of their asset and liability. If nothing happens, then they try to assess the value over the market condition. That what is the inflation happening in your land, what is this thing is happening like this. They try to find out the fair value measurement. Clear? Any doubts over it?
Sorry, I just want to confirm, Diksha, like for example, under IFRS 13, we have, I mean, first is active market where where we have the sale and purchase of 100% identical products, like you gave the example of gold. And if our product doesn't sold in active market and our product is not identical but similar, so we can try it in best market.
Yeah, you can sell it in the best market. Definitely, you can sell it in the best market.
Okay. So can you please give us an example? Like for example, for active market, you gave us an example of gold. For the best market, do you have an example so you can share with us?
But see, I will tell you one thing. It depends upon commodity to commodity. For example, gold is the thing that you can easily sell in the active market. In the observant market, what can be in the observant market? You can talk about the houses. You know one thing, that houses is something that definitely that is the land, but houses price also depend upon how, you know one thing, that sometimes your house price, you know one thing, that your government value and your actual market value is different, it's time value and everything. You know about these things with the land part.
Yes.
Many of you might be aware. So see what happens. You know very well, you don't have a very active market towards it. Active market, I can say, every house will not have a same value. Even if I construct 10 lands, let's suppose you have constructed 10 houses in the same locality with the same acre of land. Let's suppose with 3,200 square feet on. But every land will have a different value. Why? It will depend upon their constructions also. Now, one has a very good interior, that will have a different value. One is having a very bad interior, that will have a different value. So this can be a thing where no similar identical products happens.
Okay.
Means now in the housing society itself, in housing there are similar products. Definitely all over the world there are houses. But definitely that's not about, let's talk about in my locality only. If I am living in a locality, let's talk about there are 10 identical houses. Identical means they have same acre of land and everything. But still their prices will be different based on their, you can take an example of best example of your flats. In flats, what happens? The one which is in first floor, second floor, every price matters changes with the floors. Yes or no?
Yes.
Yes or no? It
Yes,
changes
yes.
with the flow. So what is this? There is no active market towards it. It definitely changes with the floor and everything. Got
So
it?
it should not be under active, it should be under best market, right?
Correct. Under best market, because see, you don't have 100% similar market now. 100% similar means you cannot definitely. Now I have seen that my neighbor has sold his out for 80 lakhs. Definitely, it's not necessary that my house will be sold for 80 lakhs. It might be less, it might be more, depending on so many factors.
Okay.
But best market means similarly identical goods available. And the third one is you have some non-existence products which don't have. Now let's take an example of you wanted to sell your two-wheeler. Definitely up now two-wheelers. If you're trying to sell your two-wheeler, now here there will be so many factors. One will be how many years back you have purchased, how much your scooty has, you are using that two-wheelers on a daily basis. The condition will be depend. So many things will be there. So you cannot find a now if I try to find out a similar condition product as like my two-wheeler with the same depreciation value with same everything, that is impossible to verify. So if you try to find out the fair value for these products, that will be based on your calculation on. Yes or no?
Yes.
Depreciation calculation, your condition calculation, everything. So this is what your IFRS 13 says. Clear? I don't know what, in this, they have written in a very different manner, but in your book, it's written in a very different manner. They have just given what is IFRS 13. They have given three types of market, like I have mentioned. That there is first market where you have the similar identical products. The second one is observant, and the third one you don't have identical products. You try to do the calculation. So please learn in the same manner. Don't try to become, don't go overboard. Got it? Clear?
Yes, Deeksha.
Any doubts anybody is having? Okay. Now, let's proceed. The next one is non-financial assets. Non-financial assets. Okay. What can be non-financial assets for you? Non-financial assets. Anybody would like to give me example? Okay, shares. Goodwill, definitely. Goodwill is a one thing. Okay. Definitely patents, trademarks, goodwill. And goodwill is the big things for every business. That is a non-financial asset. Because see, even for trademark, you pay. Even for patent, you pay. That can be a definitely a financial asset. Yes or no?
Yes.
Do you pay for goodwill?
No.
No.
Definitely, you don't pay for goodwill. Goodwill is something that comes in the business automatically by how you serve your customers. Correct. So see what happens is here non-financial assets can be a goodwill. They can be more as well. They the more can be non-financial assets. It can be goodwill. It can be brand value, self-generated assets, brand value. Got it? Now see what happens is we say one thing under this. The one is physical possibility. Physical possibility means that the asset, non-financial assets might be such as might have a physical possibility. Physical possibility, it might be have certain size, shape, it has a certain infrastructure. It has the possibility. Dex has legal permissibility. Now let's suppose if I have a very goodwill in the market and someone is trying to use my name to gain the clients, is it a legally allowed? That is not allowed now. So this is legal permission. If someone is trying to use my name over there, so have they taken the permission from me? No. If let's suppose tomorrow their company, there become any comes any XYZ company which open any franchisee without even paying the franchisee fees or something, just for a appearance or for a having let's suppose tomorrow you start a Domino's before even paying the franchisee amount, they can easily do a legal case over it. Next is financial feasibility. Financial feasibility means whether whatever the assets that you have is generating a positive return for you. Let's suppose now you know one thing. Nowadays, Byju's has a very bad goodwill in the market, right? So for sure, goodwill Byju's name is not creating a positive economic return in the company. It's becoming a negative economic return. Otherwise, Byju's were having a name at one point of time in their life. Correct. So financial feasibility means whatever the assets that you have is generating a positive economic return or no. Clear?
Diksha, one second. I mean, like, just one doubt. In the goodwill part, I mean, like, so goodwill comes out when company performs good operations and when it gives good services to its customers. So simple definition is that. And so indirectly, if you can see, so you're investing in goodwill, right? Obviously.
I would tell you one thing. You know one thing, Pranav, that you never ever record goodwill in your books if it is self-generated. If you have purchased the goodwill, what is purchased, you will see this in consolidation, purchase goodwill and everything. You will get in consolidation. Not here, I
Yeah,
can
I
explain you.
guess
You
purchase
never
goodwill
record
is
internally generated intangible assets in your business.
okay.
But still that becomes a factor which brings up now just imagine a name now I would tell you one thing, even if someone now you know something, some brands have name, people buy their products even if they don't do marketing much or anything, right?
Yeah.
So that creates a positive impact in the business, that becomes their financial feasibility, legal permissibility. If I use their name to generate revenue, that is not legally allowed.
Yeah.
Got it?
Got it. Yeah. Okay. So I mean, like purchase. Yeah, purchase goodwill is when you. I mean, like when you take over that entity, or else the entity is goodwill in the market, and after that you're taking over it for a certain transaction. That is right.
Correct. Purchase goodwill at the time of consolidation when you buy any subsidy or something and you
Okay.
see you are paying more over their values. Right. At that time it become a purchase goodwill also.
Okay. Okay. Perfect. Thank you.
At that time you record purchase goodwill.
Yeah, we record purchase goodwill. Normal goodwill. I add this. I mean, like indirectly we are investing in it, right? So I was in that zone of thinking.
See, see the what see now before I explain above part, can you see these things? Whatever I have explained you now above about IFRS 13, that you look at the level 1 input. Level 1 inputs means you have the similar products available in the market, that can be a gold stock. The next is you have an observable goods. Observable means that you have a product similar, something similar, but not 100% similar. Then third one is you don't have anything similar. You have unobservable goods will in the market. What you do is you try to see the things, you try to calculate their values on the basis of available information. Whatever I've explained you above for IFRS 13, they have just given here the similar thing. Now, they have talked about pricing, how you can estimate the fair value. The first thing is market approach. Market approach means what? Similar products available in the market, the same price you're using. The next is cost approach. Cost approach is nothing. Current replacement cost. The one I told you that you have a technology advancement example, that you have any technology advancement and you are replacing the existing asset. That is the cost approach. Third one is income approach. Income approach is nothing but value in use. Clear? Now you have next thing, that is disclosure. Disclosure is means that whenever you are using your IFRS 13 and you are trying to calculate the fair value of your product, means you are doing the valuation, you need to mention in the reasons. Okay, Muhammad has a answer. Wait a second, there's certain doubts are in the group and I forget to pick. The first one is, please explain physical possibilities for use. Physical possibilities for use. Okay, let me explain. See, physical possibilities for use is similar. Let's suppose you have anything. What should I say? Let's suppose you have any non-financial assets that has a shape, that has a physical substance. You can definitely use it, yes or no? That can be an infrastructure, that can be any utilities, that can be anything. Correct? Yes. So that is what physical possibilities. If you have anything asset, and definitely, if let's suppose you have a very good infrastructure, that can be a non-financial assets for, or you, if you have a very good infrastructure, you can say networking. That is a non-financial asset, but that is definitely a physical asset for you. Persons exist in the market. Now tomorrow, let's suppose you clear your exams and you come to me, ma'am, if you have any references, can you help us with internship part or something? Definitely. It's a non-financial asset for you. Networking is also asset in everyone's life, but it has a physical criteria. Definitely, I am physically a person, correct, that can help you in gaining something. So that is how you can use your this physical network. Clear, Ritika? Now, next question was in the chat box. That was, so if we will be buy a goodwill for Umair, is it a non-financial asset? See, I would say goodwill is definitely even if you're buying, definitely if you're paying a premium amount over the actual value, that becomes a goodwill purchase. But definitely you can say that it will be a financial assets or non-financial asset. But if I am paying for something, definitely I will say it a financial asset only. This is very subjective thing. Now comes your disclosure requirement. IFRS 13 says that you need to disclose something, that, for example, how you have calculated your fair value. You have used input 1, input 2, or input 3 while you were calculating the fair value. Third thing, you need to definitely tell the techniques if you go ahead about with 2 or 3. Let's suppose you used input 3, means you have done the calculation on the basis of market information available and used input 3. So definitely you will mention that fair value is calculated using the input 3 levels, and then you will explain the techniques that you have used in input 3s. Third thing, definitely you will also disclose about whether you have used the current cost method or a value in use method, or how is it different if you have used that. This is what you need to talk about. Means you just need to disclose whatever you have done in the notes to the financial statement. Clear? Any doubts in chapter 1 and 2? Only IFRS 13 will help you in numerical part, none else. And in IFRS 13 also, they never ask you to do the calculation. Let me tell you, you should know that IFRS 13 has 3 basis market. Other than that, chapter 1 and 2 will not help you anywhere in further chapters. You should just know IFRS 13, that too theoretically. You don't have the numerical portion in your syllabus, not in SPR, not in FR, anywhere. Aryan has a doubt from discussion paper and exposure draft. What is the difference from chapter number 1? Definitely, Aryan, I can help you with it. See what happens in discussion paper. See, if you are planning to make a new IFRS standard, so what you do, you issue a discussion paper. Discussion paper means you will be sharing a discussion paper with every nation companies to ask them to put the inputs, like whatever the issues they are facing, whatever the problems they are facing while applying any IFRS. Let's suppose you are planning to amend IFRS 13 itself. Okay, now you will issue a discussion paper to the company. Now what they will do, they will mention in it what are the problems they are facing, if there is any problem. If they have any suggestion like this, they will fill out those form. After that is discussion paper. Exposure draft is on the basis of the inputs received in the discussion paper, they prepare the exposure draft. Means they make an amendment in the standard, and then that is exposure draft. Clear? Exposure draft means they will share with the companies. That is not full and final IFRS standard after amendment. This is just a draft. Whether others are liking it or no. What are their opinions over it to get it? Clear?
Ma'am,
Yes.
ma'am, will you open page number 2?
God, they have certain. Yes, Peo.
So ma'am, here ma'am, we see that they are the stakeholders name is there, IASB. So here it is written that academics point of view. So we can relate that what we are read that are
Can
also
you
the
tell me the
stakeholders.
paragraph and line? I'm unable to explain. First of all, can you tell me?
Ma'am, this the 3.1 paragraph, 3.1 paragraph. Stakeholders line is there.
There, can you please tell me the line?
Ma'am, this fourth point academics. So here we said, as we read here also that so these are the.
Can you tell me the paragraph, like either one paragraph in points? Oh, this
Ma'am,
academics part. Okay, I got it. Academics here means is definitely your stakeholders belong from different academics. Different academics means diversity. Can I am from finance background, some might be from marketing background, some might be from your media background, isn't it?
Yes, ma'am.
Here academics means different background of your stakeholders. Not necessarily everyone will have an investor's knowledge. Important.
Okay, ma'am. So, ma'am, means, ma'am, here, ma'am, we also include academics that what we are reading will also be include here that the rules and regulations are also the stakeholders.
See, in short, just imagine, see, you will not get, first of all, this academics part. Academics means nothing. They are just saying that your stakeholders are from a different academical background, right? So whatever the information you're presenting or whatever you are doing, that should be have a in details. Tell me one thing. Do you think in a company only one finance person work? There will be salesperson as well. There will be marketing as well. There will be coordination. There will be person having a social marketing experience of different types of person there. Just this much remember. Okay, let's start with chapter number 3 then. Or let's take 15 minutes break today, like we have planned yesterday. Let's take 15 minutes break. Let's start in 9:15. Then we will take a break after 1.5 hours, like we discussed yesterday. Whatever will be better from us, we will take from the next class. We will implement that. So we will resume class at 9:15. Please be on time. I will not wait for anyone. Okay. Hi guys, are you back?
Yes.
Okay, so let's get started. Mayank has asked me in the chat box, ma'am, we will be doing the practice for exam kit solution or something like this for chapter. See, I will tell you. But these chapters, chapter number 1, 2, what we have covered or what we are going to cover, IAS 1 and accounting policies. Accounting policy is important, definitely. That is one thing we should do questions. From these chapter, you hardly get 2 MCQ from the whole syllabus. When I say it means it. Okay. And practicing a lot of question does not make sense. You have a broader understanding over it. You can practice that. But when we will be doing the numerical topics like leases, your customers, contract IFRS 15, taxes, at time definitely we will be doing a lot of questions. Got it? I am saying that for these starting chapters, Mayank, they are not tricky questions. It's just they have played well with the language. We will do few MCQs. Don't worry. I will plan on doing few MCQs, but not a lot of questions. A lot of means 5-7 MCQs, not 30-40 or 20-30 MCQs. Otherwise, like this, we will not be able to complete the syllabus on time. From the day one, we should know the value of time. Because when we will be doing the 20 mark and a long question, I know you guys will not make me do more than 2 questions in a day. Okay, let's start. See, the only solution is that for your BPP and Kaplan is I will be doing in the class VG learning this. In this book, they have given a lot of questions. I will be doing those questions in the class. You guys can do either BPP or Kaplan, whichever you are comfortable. And in case of doubts, you can definitely ask me. Got it? Now, let's start this with, and I think someone of you asked me about the study plan that I am still creating. That will be taking with me a little bit, a little bit more time. I will be creating done by tonight, and I will share in the WhatsApp group, and along with the drive link as well, where you need to create your folders and upload your files. Everything will be given to you by tonight. Okay. Let's start with IAS 1 presentation of financial statements. Now see. In IAS 1 presentation of financial statement, the first thing that you have is whenever you are preparing the financial statements, you have two objectives in your mind. The first objective is that you can easily compare your information, your company's performance with other companies. Plus, you can easily compare your year-on-year performance. Whenever you're preparing financial statements, you have two purpose. The first one is you can compare your performance with other companies' performance. The next one is definitely you can compare your past financial performance, whether you're growing or no. Now, the next thing that you have is definitely how you apply IAS 1 in your financial statements. The first thing is that whenever you prepare your financial statements, the first thing that you need to ensure is that your financial statements, one thing, one is individual financial statement, one is consolidation financial statements. You know the difference? Individual means companies and consolidation means parent company, subsidiary, everything is presented in there. So IAS 1 is applied in individual financial statement as well as in consolidation financial statement. It doesn't matter that companies from whichever background, either it's bank, it's insurance companies or whatever. IAS 1 is applied everywhere. The next thing that you have is either entity is a profit making or an NPO, non-profit organization, or it's from a public sector or from a private sector. It doesn't matter, they needs to follow IAS 1. Clear? The next thing that you have is definitely, you prepare a financial statements in such a manner. The first thing that any company do is, first of all, they record transactions. They pass the journal entry, then they prepare ledger account, then they prepare trial balance. Yes or no? After trial balance, they prepare a statement of profit and loss, then they prepare balance sheet, other comprehensive income. So there is a structure way they follow. Anyone tell me why we prepare trial balance? Anyone of you know why we prepare trial balance?
To know the arithmetical accuracy of book of accounts, like bifurcation of the income and expenses.
It's a summary of all ledger accounts, so we can use that to prepare the financial statements.
Can I say this, that when you prepare your trial balance, the ultimate goal is to check whether credit balances are equal to debit balance. Also, is there any errors or something? Because one thing, every companies record general entries on a daily basis. Then they prepare ledger account. The ultimate goal of preparing the ledger account is to know what is the final balance of receivable, what is the final balance of payables, right? Then from ledger accounts, they prepare trial balance to understand if you have done any error or omission. After making all the correction, then you start preparing your P&L account, your cash flow statement, your financial balance sheet, your changes to comprehensive income account. Everything is prepared after that. Yeah, to know the financial accuracy of the business, everything. Now, one thing, that whenever you are presenting your financial statements, there are two objectives behind it. The first one is management stewardship. Management stewardship means how effectively your management is handling the economic resources. Now, let's suppose you have invested 10 lakh in your business and you're unable to even generate 1 lakh rupees annually. I'm talking about, let's leave it even monthly. So, definitely, your management is not handling your business very well. Yes or no? Definitely, your financial statements are prepared to know your management stewardship, your management performance. Because when you will be preparing the financial statements, definitely you can know whether your business is growing or no. How much you have spent in advertisement, what is the thing, you can definitely find out a trend. The next thing is future net cash inflows. Now, one thing, now looking at today's what, let's suppose last year you did a revenue of 1 crore. This year you did a revenue of 1.3 crores. That means 30% progress. So, same way, if you do a year on year analysis, you can easily find out the growth rate for a business and you can evaluate a futures amount. Yes or no? That is again a objective why we prepare financial statements. Next, what are financial statements? You know very well, that is financial position, that is balance sheet. Other comprehensive income, profit and loss account. Profit and loss account is also known as income statement. Next, you have changes in equity. Fourth, you have is cash flow. And the last one you have is explanatory notes. You can say explanatory notes as a disclosure notes. Any doubts? This is very basic things, not very tough. The next thing that you have is firstly we will complete this chapter, this chapter number 3, then I will look after first, second and third chapter questions. Today we will try to do this much, and from the next class we will start from the numerical portion as. Now you have supplementary statement. Supplementary statement is, now you know this. This is not required by organization to prepare it. Now you know one thing, in today's era, sustainability has become a important factor for any company to follow sustainability development. If they are issuing environmental reports, or if they are issuing a management commentary reports, that is not mandatory. They are just issuing it to gain a public goodwill. If some companies issuing an environmental report, they will try to showcase how much environment resources they are using and how they are presenting it to the society, or how they are giving back something to the society. Like, let's suppose there is a wood manufacturing company, not wood, sorry, a furniture company. Definitely, if that is a furniture company, they will be cutting down our trees. If they issue a report in which they are, even if they are cutting down the trees, they are sharing how they are returning back to the society by planting the trees or doing whatever the benefits they are doing to the society. So what they will earn? They will earn definitely a public sympathy, or you can say a public goodwill. So ultimate goal, whenever any company is issuing these supplementary statements, be it your environmental report, be it your management commentary, anything, the ultimate goal is just one: to ensure that they are able to get a public goodwill, nothing else. In management, yeah, they are, if they are preparing it, they will attach with the annual report. If they are issuing any of the supplementary statements, they will attach with 100% with your annual report. You have value added statements. Value added statements means nothing, whatever the something additional they want to disclose, so they are disclosing it in value added statements. Management commentary, like this you have. Faithful representation and compliance with IFRS, you know very well. Faithful representation means you are accurately preparing financial position, financial performance. Financial performance means P&L account, and cash flow generating. Cash flow generating means cash flow statements. You are preparing these three statements very accurately. This is what they mean to say. Accuracy means, you know, if you're presenting anything, you're following all the IFRS standards. Let's suppose you wanted to calculate the provision, warranty provision. You have accurately used the IAS 37. That will come under the faithful representation part. Got it? Anyone has any doubts? See, this is very theoretical. This is very basic. That's why I'm not going into again depth to come up with again the same examples. If you're unable to understand anything, you can definitely ask me. Now, see, next thing is, definitely whenever you say faithful representation, you need to ensure you are using the appropriate accounting policies. Appropriate accounting policies. Okay, do you guys know? And actual, there are not just only two depreciation method. In the syllabus, you just study two, that is straight line and your reducing balance method. There is double depreciation method also. There is input depreciation method also. That is also companies follow. But in syllabus, you never studied it. So if companies are using them, they should be consistent over it. They are following all the accounting principles and rules. They means that whenever you say faithful representative, you need to ensure you are using the correct accounting standards. You are correct, absolutely correctly using the accounting policies. Clear? For example, I am saying you need to do the inventory valuation. You should know that for inventory valuation, there is IAS to inventories. So you are appropriately using it. If you wanted to record the uh, for leases, there is IFRS 16. You are following it. There are see, I have studied till 4 depreciation methods. In my extra courses, I have a little bit more deep knowledge. That is 4, but that is not in your syllabus, so I will not tell you to confuse and then explain and go ahead with 30-20 minutes extra lecture. And when we are running, from my speed, we are running a little bit slow. But there are more. But you don't have anywhere in your ACCA syllabus. If you do any other course, you might got a chance to learn it. What is with this? I don't know what's the problem with this PDF. I'm the only person who faced this issue. Okay. Next thing that you have is definitionally additional disclosures. Now, sometimes even if you are making an additional disclosure, you know about contingent liabilities, contingent assets, you do make a disclosure. It's allowed if you make an additional disclosure. But whatever the disclosure you are making, they should have a sufficient information. You should not provide insufficient information. These are the areas where you look after. Again, I am repeating, you are look after, first of all, whether you have used the appropriate standards and accounting policies. When I say appropriate standards, I mean for inventory, there is IAS 2. So you are using IAS 2 only. If there is for provision, you have IAS 37. You are using IAS 37. For intangible non-current assets, you have IAS 38. You are using that. From next class, I will do that. Otherwise, what's the issue now? If I will open it somewhere else, now I cannot use my pen tab to write something over the screen. That's my reason. If I use Zoom screen, Zoom pen tab, then what will happen? The notes will not be saved. So there are certain issues with it. Got it? Next thing is departure from IFRS. Now, you know one thing. This departure from IFRS means now you know that there are many companies which do not follow compliance. They don't do compliance properly. When I say compliance, compliance means you are okay. The further I got a very good question, and I was expecting that anyone will ask me for sure how to memorize all the IS. You should memorize. And let me tell you, if you ask me tomorrow whether we need to learn which IFRS stands for what, yes, you need to know. And as we start learning the topic, for now we have just till now we have just covered 2 IAS for now. IFRS 13, that is fair value, and second IAS we are studying IAS 1, that is financial statement. These two IAS are IAS and IFRS are something which is just theory, no numerical, nothing, and you don't even get a question. Even if you get, that is just a numerical question, oh sorry, theoretical MCQ over it. That's why I am so lenient over it. When we will be studying this IFRS 15, IAS 16, IFRS 16, all these topics, IAS 16, we will be doing a questions. You will learn yourself as we'll start proceeding the syllabus. And otherwise, what you can do, I will tell you one thing. When I was studying this FR, what I did, I was having at that time sticky notes. And wherever you study on your table, wherever you prefer, either on mirror, wherever, if you are a person who look after mirrors 24/7, there are persons who are very obsessed. Stick at your mirror, stick in front of your table, where you can look at it 10 times in a day. You will remember it already. Got it? The best method is make a sticky notes, stick to your wall where you look after. Clear? Now, departure from IFRS means International Financial Reporting Standards. The first thing that you know is that every company is required to do a lot of compliance. When I say compliance means they are on On time they are filing their GST, on time they are paying their taxes, on file they have to fill certain forms. I don't know much about these things, but there are 4 5 forms they are required to fill. One is form 16. Like this, there are certain forms they are required to fill. If they are filling on time, they are doing their director registration, everything on time, that is what compliance means, is you are preparing your financial statements in true manner and everything. So the first thing that they in the, from IFRS is you need to ensure that your financial statements are prepared in a true manner. In a true manner means they have represented the actual values. You haven't overstated the or understated the balances. The second thing is you have compliance. Compliance means whatever the compliance that your firm were required to conduct, you have done all the compliance. The third thing is that you have is definitely whatever the standards you are using, whatever the standards you are using, you are properly showing their treatment. Properly showing their treatment means is, for example, let's suppose I have adopted IAS 38 for my research and development, and anyways, that is what you need to apply. Whatever the transaction, whatever the calculation you are doing, it should be an accurate manner as per the IAS standards. You are not overriding it. Overriding means you are not trying to showcase your uh, research cost as a development cost. The last thing that you have, definitely you need to look after it if there is any misleading information. Is it impacting your company's profit? Can it make any profit into loss? For example, let's suppose your company was not performing well, you decided to overcast the revenue figures and others. If you're over presenting your revenues, what will happen? The first thing that will happen is definitely your your loss can be converted into profit. Yes or no? You can convert your profit into loss. You can convert your loss into profit. So if these size things are happening, that is what we say departure from IFRS. Means you are not presenting your true position. Clear? Any doubts still here? Going concern we have already discussed. Accrual accounting we have already discussed. Any doubts still here before I proceed with the matching concept?
No, ma'am.
Good, Deeksha.
Okay. Now you have a matching concept. Matching concept means uh, that your revenue and expenses should be matched and recognized in the same period. Let's suppose, okay, anyone of you like to give me a matching concept example? Okay, let me give. No one knows. See, let's suppose there is any company which makes gadgets. Okay, and let's suppose there was a customers who give them a special, you can say a contract or a special demand for any particular gadget, and for that he will be required to pay $1,000. Okay, now you know the revenue generated is $1,000. If whatever the wages means the labor cost, the product cost, whatever you have incurred, you will be recording in the same accounting year where the revenue is generated. It doesn't make sense even if you have a asset ready, or you can say, let's suppose your customer is paying, or let's suppose you have prepared a goods now, but your sale is happening after 6 months. You will be recording your revenue and expenses in the same accounting year, not in different. Got it? Yes, Kanika, absolutely correct. It should always be matching. Your invoice amount and the cost should be matching. It's not like if, let's suppose you have generated revenue today and the cost amount you need to pay is after 6 months or 9 months, but you will be representing it after 9 months. No, you will be representing now only in the same accounting year. Got it? That it should be matched clearly. You might have. Next is consistency. Consistency again, that whichever IFRS IA standards you are adopting. Matching concept means is simply in simple language that if you are generating revenue today, then you need to the related expenses related to the revenue should be recorded in the same accounting year. You cannot record it early or afterwards. That is what your matching concept says. They are matched and they are related to each other. Now, consistency of presentation. Consistency of presentation clearly means is that whatever the IFRS IA standard that you are adopting, that are consistent with each other. When I say consistent, I mean is that let's suppose Hardik is using what we say, let's take an example of, let's not take example of depreciation. Let's take an example, you have an inventory. There are certain methods, whether you use unit LIFO method, you use unit cost method, you use FIFO method, like this. There are certain methods. You guys are exemption students, whosoever has studied management accounting, you might be aware of these things. So if let's suppose he is using LIFO method, so he should be consistent on evaluating his inventory over the LIFO method only. Not like today he is using LIFO, other day he start using unit cost. No, that is not accepted. Consistency means you are using a consistent principle. Any doubts still here? Okay. Next you have materiality and aggregation. What is materiality and aggregation? Materiality means, let's suppose you forget to record any information. Let's suppose, okay, let's take an example. Manu was creating a balance sheet and she forget to record 50,000 expense. Her net profit is $25,000 and she forget to record $50,000 expense. Now see, she forget to record such a big amount. Now what will happen due to her omission? First of all, not only expenses are understated, even profit is overstated. Correct. And this will definitely can lead my decision as a mislead decision. I have seen, okay, oh, wow, company is doing a profit, I can easily invest, but an actual company was doing a loss. It has impacted my decision or no as a user of financial statement. So materiality means if you forget to record such big transaction, that is known as materiality amount, which can change your entire decision. Clear? I think any one of you is preparing for audit, then you might be aware of what is materiality if you have reached till there. Next you have is offsetting. Okay, now what is this offsetting? Have you ever heard about offsetting? Aggregate means combination. Let's suppose there are small amounts that you forget to record, 10 rupees, 15 rupees, 20 rupees. If you aggregate them together, accurate means you accumulate them together and it becomes a big amount. That is aggregate. Ritika is saying offset is equal to compensation. Okay. Anyone else? Can I say that offsetting, like for example, let's suppose, let's take an example. Abhishek was required to pay anyone $100. Okay, and that person was also required to pay Abhishek $120. So isn't it they can offset the amount and that person can pay Abhishek the remaining $20? Yes or no?
Yeah,
That is what
yes, it can be possible.
yes, it is possible, and that is what offsetting is. So what happens in offsetted? For example, you have any asset or liability balance, correct? Or let's suppose, you know one thing that according to your income tax law, if your company is incurring a loss, they can take the benefit, or they can offset those losses, and they can carry forward it for next 2 years. That is also a part of offsetting. If your company has incurred a loss, you can definitely offset those loss for the next 2 accounting period. That is also come under offsetting only. Clear?
Ma'am, may you
Yeah,
repeat the last example?
yes, I can repeat definitely. I am saying that offsetting means, let's suppose your business incurred loss this year. You know your IA is 12, that is income taxes, that permits to you can carry forward these losses for next 2 accounting period. So your tax can be reduced in the coming 2 years, yes or no? That is what offsetting is.
Okay, ma'am.
And now tell me one thing. If I ask you to calculate profit or loss on disposal of assets, definitely we haven't studied that much. I haven't explained you how to calculate it. So what you will be looking at? From the sale value, whatever the amount you are gaining, whatever the amount you are receiving for selling the assets, you will also reduce the carrying value of it. What is the current carrying value? Yes or no? And once you have deducted the carrying value, the remaining balance will be the gain or loss, yes or no? That is again offsetting. This is what offsetting is, nothing else. Same way, next thing that you have is comparative information. Comparative information is nothing. Comparative information is that, you know one thing. Have you ever seen a real life balance sheet? Any company's balance sheet?
Yes, ma'am. Yes, ma'am.
Whoever has not seen a, please search for it. You will see that, for example, if suppose they are preparing 2023 March balances, or you are saying 2023 April to 2024 March, if they have presented those balance sheet, na, they will also prepare last year balance. Last year balances will be 2022 April, 2023 March. They present like this in the actual balance, in actual annual report, yes or no? They present 2 years balances to you. Current year and last year. That is known as comparative information. So that you can make a comparison. Comparative financial statement of 1 year at least should be presented. This is what comparative information is. You can see any company's balance sheet, you will 100% see that they have given you current year as well as last year performance, so that you can do a comparison. That is what comparative information is. IAS 1. If you are adopting IAS 1 themselves is a disclosure. You don't need to make any disclosure in the notes to the financial statements related to IAS 1. Why? IAS 1 is nothing but IAS 1 tell you that your financial statement has certain, that under financial statements you need to prepare a balance sheet, income statement, statement of cash flow. They themselves is a disclosure. Got it? Okay. Next thing is, okay. See, IAS and IFRS both is in your syllabus. IAS, if there is something inventory, there is only IAS over it, no IFRS. Got it? To definitely need to learn both. What is IAS? What is IFRS?
Ma'am, how many IFRS we have in total and
Around
IAS?
40, more than 40, 40, 44, 45, 6, around this.
And what about IAS? How many IAS we have?
Combined, I am talking about.
Okay, you are talking about both IAS and IFRS. We have are in between
Around
40 to
40, you
50.
have 30. Yeah, around you have 40, approx.
Okay, okay.
But that is but that much is not in your, I would say, in your FR syllabus you can talk about approx 30. In SBR, when you will be studying SBR, strategic business reporting, at your P level, at that time you will have more. You will
Okay,
100% have a little bit more like share based payment, which is not in your syllabus now. There are so many
okay,
IFRS which are not in your syllabus now, but on later on you.
okay, okay.
Yeah. Next thing is, whenever you identify any financial statements or you are preparing your financial statements or your annual report, it should have the name of, if you are having, you have presented a balance sheet, it should have a label of a statement of financial portion. If you're presenting a income statement, you should have a label of a statement of P&L account. Same way, it should have your entity's name over it. It should have whether it's an individual entity or group, everything should be presented in your annual report. They have written this. What are the currency you have written? Are your amounts in millions? Are it's in thousands? Everything is presented in balance sheet. Clear? This is anyone's very general thing of a common sense, that whenever you are presenting, definitely you will write the currency. You will write whether your presented amount is in crores, is in full amounts, is in thousands, it is in millions. Next thing that you have is reporting date and period. Reporting date and period means is clearly your balance sheet is from which period to which period. For example, I am saying it's from April 1st, 2023 to 31st March 2024. So you need to clearly mention your dates, starting date till the end date, because you know very well in India it's April to March, in UK and somewhere it's January to December. It's not necessary that your every country will have a same accounting period. Okay, tell me one thing. Do I need to tell you what is, do I need to tell you, explain you statement of financial state position, or you can clearly read yourself? Yeah, because see, I don't think so. I need to explain you what is asset, what is liabilities. This will be like I'm teaching 11th class students. But still, if you have doubts, you are always welcome to ask. See, they have given you statement of financial position. I can say that in non-current assets, they write the balances for whichever assets you will hold for more than 12 months or more than one accounting period. In current assets, you have the assets which you will hold for next 12 months. This is how they have given you the pro forma of a statement of financial position, how you present it. See clearly. They have given you comparative information. Current year balance with the last year balances. That I was talking about. Clear? Now see. This is very easy. They have just given you the presentation of assets, liabilities, like property, plant, and equipment is up. Okay, property, plant, and equipment, non-current assets, investment property. Tell me, current assets, non-current assets.
Property, plant and equipment. The
Non-current asset.
non-current
Non-current asset.
assets. These are
Definitely non-current assets. Very good. Intangible assets, again non-current assets.
No.
Financial assets. Financial assets now will be again a complex process. If financial assets, for example, if you are holding something for short-term investment or a trade receivables, then it will be a
Current level.
current
Current.
assets. And if you are having a long-term investment, that will be a non-current asset.
non-current.
It is again a process of debate. Asset held for sale, it will be recorded separately, yes or no, on the face
Yes.
of the balance sheet, on the face of the P&L account. You will study this thing. Asset held for sale, you have a IFRS 5 for it, that you will be studying. The same way you have biological assets, inventory, they have just given you the comparison over it, and I am not doing it. This is too. You can yourself read it. And if you have any doubts in anywhere, you can definitely ask me. This what is not this non-controlling interest and everything. You will be studying non-controlling interest means you have a, let's suppose, let me tell you about non-controlling interest. Let's suppose you have invested in any subsidiary and you own 80% of it, not 100%, 80% of it. So 80% becomes 80% becomes your control 20%. Let's suppose you have invested in any companies and you have gained acquired 80% of the shares. So 20% is a non-controlling interest for you, that will come as a live that comes in equity part. Important, because that is not your business. Clear or no?
Clear.
You will be studying all these things in consolidation. Don't force yourselves to study everything now. Next you have is the statement of P&L and comprehensive income. A statement of P&L. A statement of P&L where you record all your revenue, where you try to calculate your profit from revenue, subtract your cost of sales. You got your gross profit. From them you then deduct your non-profit, operating expenses. You got your operating profit. Then you deduct your non-operating expenses. You get your profit before tax. Then you calculate the tax part over it in different things. That is your balance sheet. Next you have is other comprehensive income. Okay, why we prepare other comprehensive income? Who will tell me? Who will tell me why we prepare other comprehensive income? For evaluation, okay. Any other reason? For other income purpose, okay, that can be definitely one. Losses to check revaluation over valuation, revaluation gains, definitely. See, whenever I say other comprehensive income, first of all, if you're definitely, there is always changes in revaluation surplus. Correct. Someone has returned. To know how much income is generating from non-trading activities. Very good, Pranav. Non-trading activities means non-operations of your business. For example, from revaluation surplus, from even, okay, tell me one thing. You have invested in shares, your company has invested in shares. If you are earning gain over it, that will come under other comprehensive income or in your P&L balance. Other comprehensive income, definitely. And one thing, tell me one thing. Even if you are saying, I have, let's suppose you are saying my land value last year was $10,000. This year it's become $11,000. You have earned $1,000 as a revaluation. Have you received the cash? No, na. You haven't received the cash. So how you can write it in P&L? That's my always question whenever someone asks me why we are preparing other comprehensive. Now look at it, you are not actually receiving the cash. That's a capital gain for you. That's a capital gain for you. Definitely, you will record it in other comprehensive. You sell your land today, you can then in that scenario you can definitely get a cash. Otherwise, you are not getting a cash. We will study about provision in provision chapters. Now see, one more thing that comes under this is definitely you have no cash flow hedges. Cash flow hedges again is your IFRS 9. You will study about it in IFRS 9 chapter. And cash flow hedge is not much in FR syllabus, but in SBR it is in very detail. Your strategic business reporting. Your remeasurement of defined benefit pension plans. This is not again in your syllabus. This is in SBR syllabus. Same, this is an SBR syllabus. This is an SBR syllabus. These three topics are in SBR syllabus that comes in other comprehensive income. That is not in your FR syllabus. Generally, you prepare other comprehensive income is just to showcase the non-trading activities revaluation or gain over it, you can say. Any doubts still here? When I will ask the questions today, then don't tell me I don't know the answer. Once we are done with these 2-3 pages are remaining, then I will start solving questions related to this.
So other comprehensive income examples could be, I mean, like you're getting, can you just provide 2 3 examples for other comprehensive income?
Sorry, can you please repeat, Pranav?
Yeah. Just I'm asking is, I mean, like, can you tell us some 2 3 examples of other comprehensive income?
Yeah, I can give you examples of other comprehensive income. The first is the revaluation surplus. You know one thing, if let's suppose let's suppose your asset was revalued, now it's devalued. First of all, your balances are offset against other comprehensive income only. You know this thing?
No, I'm not aware of it.
See one thing. That let's suppose you have a revaluation surplus related to any XYZ thing is $1,000. Now you realize your asset value has devalued. That's happened in very rare cases or in the cases of machinery whose value is evaluated more. So what happened in that scenario? What you do is first of all you offset the balances in the other comprehensive income, and if the balance is more, then you take it as a loss in P&L.
Okay.
Also, the other example is, for example, you are converting, let's suppose you have $10,000 in foreign exchange. If you're retranslating that currency into your home currency, whatever the gain you're getting, that comes in other comprehensive income. And if you have sold any securities or anything that you were having the capital investment and you are getting gain over it, that will again come under other comprehensive income. If you have let's suppose you were having the benefit pension scheme. In benefit pension scheme, what happens, the company, whatever the amount that for the pension they are receiving, they invested. If any gain over it they are getting, again it comes in other comprehensive income. Clear?
So, I mean, like, to sum up what you said, I mean, like, in P&L account, we'll record all the direct incomes which you are receiving. And in the
Correct.
non-comprehensive income, we record, I mean, like, the non-activities through which we have earned income, I mean, like, depending upon the consideration of the situation.
Correct, which is not from the normal course of business, you can say. I'm now talk about this. If you are doing currency translation and you are gaining a gain over it, that's not from a normal trading of your business.
Yeah. Okay. Now I'm clear. Yeah. Thank you.
Okay. Next thing that you have is material items. Material items means Material items of income or expense should be individually disclosed, including but not limited to assets write-downs, costs related to restructuring activities. Now, what they mean is saying is, now you know something. Let's suppose I gave you an example of surplus. Let's suppose there was any asset, any XYZ asset, okay, that was having a value. Let's suppose you revaluated and you were having a revaluation surplus of $2,000. Now you got to know that due to certain issues, your asset is original value is $10,000, revalued value is $2,000. Now its value become, let's talk about $7,500. Now 2,500 is less. You can definitely write off 2,000 from this revaluation surplus, and remaining 500 will go to your P&L account as an expense or as a loss, right? So what they say is, and definitely 2,500 is not a small amount. So whenever you are making these asset write down, you should disclose them in the notes to the financial statements. If your company is going for restructure means, now let's suppose you are planning to pivot your business. Pivot means you have, let's suppose you have a business of cinema halls, and you have across the India, you have so many screens. Now you got to know that some of your screens are going in losses. You decided, okay, let me pivot my business, let me restructure my business, let me close down those loss making units and spend amount over making existing cinema halls more luxurious. That will be a restructuring activity. If you're conducting any restructuring activity, you should disclose this in the notes of the financial statement. If you have make any asset disposal means you were, let's suppose you were earlier you were having 10 vehicles and you decided to sell 2 vehicles. You should disclose this also in the notes to the financial statements, because ultimately that will increase your profit. Now if you're discontinuing, let's suppose you were having a business in 4 regions, you decided, okay, I am going to shut down my business in North America, then you should disclose them in the notes of the financial statement. If there is something related to the legal means your any court case is going on, you have a legal settlement to make even in the future, you need to disclose that also in the financial notes to the financial statements. Any doubts? Now let's talk about the statement of changes in equity. Many of you might not know it. Any one of you know what is the statement of changes in equity?
It's information on equity, capital, and reserves and surplus account.
Okay.
It-
Statement of changes in equity means nothing. It is all about capital and reserves. Let's suppose you are reissuing more shares, you are buying back the shares in the market, you are issuing the dividend, and you need to find out the actual share capital value, actual share premium, actual share devaluation surplus. You can clearly make a statement of changes in equity. When you need to know the actual value of revaluation, actual value of retained earnings, you are issuing more share during the year, or you have buy back the shares from the market. In such scenarios, you make a statement of changes in equity. Got it? This is your structure. It showcases about your share capital, share premium, revaluation surplus, retained earnings, non-controlling interest, or total equity. Any doubts over it? You can read all these things at your home once.
नहीं ये बिजली का है
Vinod, are you saying
हाँ
something? Yeah, I can repeat, Varsha. What I am saying is that That statement of changes in equity is nothing. Let's suppose you have currently you have 1000 shares in issue. You decided to issue 200 more shares in the market. In that situation, you prepare statement of changes in equity, right? Or you are buying back the shares from the market. Again, you will prepare the statement of changes. Here, you just try to recalculate your share value when you're reissuing the share. You are buying back the share. You have a non-controlling interest. You are here just trying to find out the share capital value, share premium. You can read, just look at it once. This format, everyone. Okay, read the theory. I'm giving you 5 minutes. Everyone, quickly read this theory. Statement of changes in equity only theory, not everything.
Uh, so Diksha, here non-controlling interest includes employees also.
No,
I mean,
employees.
what does that mean? Non-controlling interest, because owner is like shareholders. Like, okay,
See. I mean to say is non-controlling interests is, let's suppose you have a parent company. Parent company has invested in any other company and they have acquired 80% of the shares. You don't have 100% ownership. You have just 80% ownership. So 20% shares are not yours.
yes.
Yours are only 80% shares. Yes or no? That is non-controlling interest. Over the over the 20% shares, whatever the profit you are getting or whatever the revaluation surplus you are getting, that is not 100% yours. 80% is your, 20% is others. You will study about non-controlling interest in more detail in your consolidation.
In consolidation, okay.
Yes, in consolidation.
Ma'am, is this statement of changes in equity is important for exam point of view?
No, you'll never get a point to write to make it. I will tell you, you will never get. You know what you get. You either get a small part to solve the calculation. They have just given it to you. And in consolidation itself, they either ask you to prepare a consolidated statement of P&L, a statement of balance sheet, or cash flow. Cash flow also very rare. Just three things they ask you. Never you get a statement of preparation of this changes in equity or other comprehensive income. Other comprehensive income sometimes you get, but a statement of changes never ever. In entire FRSBR, you will not get even a single question around. But you should know the format. Being an ACCA student, that's why I am not even focusing over it.
So ma'am, it interfere in the numerical portion also?
No.
No? Okay, ma'am.
I will tell you the important chapters are starting from next class. I would say that will be IFRS 15. Way important. We will cover IAS agriculture also, IAS to inventory also. That is way important. But these things are way theoretical. You're from chapter number 1, 2, 3, even 4. Out of these 4 chapters, you can even ask your whosoever has wrote your FR till now. You will get maximum 2 or 3 MCQs, not even a full-fledged question. They will not ask you such simple things. This is just a basics things that you should know.
Okay.
Any doubts before I proceed?
No, ma'am.
Anyone is having any doubts?
No, ma'am. Ma'am, I wanted to ask that the 15-minute break which is remaining, it is there. So, ma'am, will you give this 15-minute break in last somehow that 11:15 to 11:30 means you will, if your class will be over at 11:15, so it will be good for all us instead of giving 15-minute breaks. Means the remaining 15-minute.
I got your point, but we will take break in between. No point of arguing. Let's proceed. Reclassification. Now, reclassification means simply a reclassification adjustment is an amount recycled to profit or loss in the current year, typically upon realization that was previously recognized in OCI. Clearly, simply means is I gave you guys an example. Or let's suppose reclassification. See, in reclassification, what happens? Let's suppose there was any land. Okay, you purchased that land at $5,000. It was revalued by $1,000. Means $6,000 is now carrying value. Can I say? Now you sold it at $6,000 itself. So this $1,000 revaluation will move from OCI to P&L account as a profit. Got it or no? Means once you have disposed of the assets, your revaluation surplus will move from OCI to P&L. That is known as reclassification. Clear? Let me give you guys one more example. Okay. Let's suppose again, let's suppose there was any machinery or there was a reserve. Let's suppose there was a any reserve, any XYZ reserve was there. You know, companies prepare reserves, right? There was any reserve and that you have used. Let's suppose you have prepared any reserve for, let's suppose you prepared, what reserve you have prepared? Shall I say? You prepared a pension scheme reserve. Let's suppose you have prepared a pension scheme reserve. Now what happens? Your company has amended the pension scheme benefits. Amended means they have made the certain changes or they had outsourced it to someone else. So definitely they will do what? From reserve, from the reserve, from your statement of changes in equity or from OCI will move to P&L, either as a loss or profit after doing the certain calculation. This is in SBR syllabus, not here. This is IAS 19, that is in your SBR syllabus. Clear? Means you are reclassifying it. From one account, you are moving it to somewhere else.
Yeah, so does have a double impact. I mean, like in PNL, it will go to the, I mean, like either income or loss, and in the balance sheet, it will go to, if it is an income, it will go to retained earnings. So it has a double
Correct.
impact, right?
Correct.
So if it is a loss in the balance sheet, then it will go to the liability, I mean, like liability.
Correct. Now, sir, tell me one thing. Let's suppose I am saying, you know, one thing about capital gains or one, whatever the gains you're recording in OCI. There are so many things that is recorded in OCI. You will be studying in a lot of IFRS. For example, you will be studying IFRS 9, where a lot of things are mentioned in OCI. Once you dispose of the assets, that move from OCI to P&L, either as the loss or profit that comes according to the calculations. That is generally the meaning of, you need to know the meaning of reclassification. That is the meaning of reclassification. Now you have transfer within equity. Transfer within equity means is while many items in OCI cannot be reclassified into P&L account, certain standards permits between components of equity. Components of equity means something, let's suppose IAS 16 permits the transfer of revaluation surplus to retained earnings upon realization. Now you know one thing. I haven't taught you IAS 16. IAS 16 stands for property, plant and equipment first of all. Let's suppose you have mentioned something you took into revaluation surplus. Okay. After, tell me one thing, from revaluation surplus, you are carrying it to P&L. Okay. Revaluation surplus from OCI, you are carrying it to your P&L account. Don't you think so? It will not impact only your P&L account, also your retained earnings. It will impact your retained earnings as well, na? When we will
Yes.
when we will do the questions, it will make more sense to you as we start proceeding with the long questions, right? But for now, just understand these things, that when they are saying with transfer within equity means that instead of taking into P&L account, what you are doing, you are taking your revaluation surplus into retained earnings. That is transfer within equity. And this happens with certain standards. Like for example, your IAS 16 permits this thing. This is either you can take it as a P&L or you can take it into a retained earnings. This allows within certain standards. Clear? Now notes to the financial statement, notes to the financial base statement. First thing is basis of preparation. Basis of preparation means you have prepared on the basis of going concern or breakup basis. Going concern means your business is going to be continue for the unforeseeable future, and breakup basis means uh, uh your business is going to be cannot survive for next 12 months. You have a doubts, so you need to mention which method you have used. Second thing, whatever the accounting policies, whether you have which depreciation method you have used, what policies you have used, everything you need to mention. What IFRS standards you are using, what policies you are applying, everything, what are the contingencies, whatever the things are, you need to mention everything. Here ends this chapter. Any doubts over it? Before I start with questions.
So Diksha, I have one doubt regarding the reclassification. You gave us two examples. First one was related to value of land, and the second one was related to the pension reserve scheme. So could you please explain me the pension reserve scheme? Like you said that suppose the
See, I
company.
can tell you this much. This is a very detailed topic, very, very detailed topic. If I start explaining you, I need to start from IAS 19 starting. That takes at least 2 hours. I can just, that's why I give you just an
Okay.
idea that what happens in employee benefits. You have this in your ACC syllabus, but at SBR level, not in FR. Okay, so
Okay.
what
Okay.
happens? Let's suppose every company has employee benefit plans, correct?
Yes.
So what happens? Let's suppose whatever the amount you invest for your PF. that goes for reinvestment purpose so that that amount can grow. Correct. So now company has changed the certain criteria over it. If company is changing certain criteria over it, so what will happen? There will be definitely certain calculations that will be required to do. Either you will be earning a profit over it or loss over it. That is what I was talking.
Okay, okay. So in that case, that particular amount will transfer from OCI to P&L account.
Correct.
Okay. Yeah.
You guys can look after these chapters once, then we will start with the questions.
Diksha, the revaluation surplus, I mean, like
Hmm.
previous topic which I discussed. So in that, as we, I mean, like as you mentioned, we can directly record it in retained earnings.
Yeah, it can that is allowed in certain standards, not everywhere. Now tell
Okay,
me one
so
thing, if you are having an asset over which you are revaluing it, definitely it should go into P&L, but certain standards like IAS 16 says instead of taking into P&L, you can directly take into retained earnings. Right.
okay,
So
so
that
this
is
provision
equity
will be
transfer, but
mentioned.
that is allowed under certain standards.
Okay. So if it is mentioned as that provision, then it is not required to record in the P&L statement.
That
Perfect.
every time you cannot do it. It is allowed in certain standards only. Let's do few questions. That will be, I think, after 300 page only.
Ma'am,
Yeah.
will we take next chapter with practical ones?
Sorry.
Ma'am, will we take next chapter practical one means numerical chapters?
Yeah, we will start with numerical only, but the only thing is accounting policies remaining. That is a very small chapter, just 20 minutes. Okay. Then I will start with now only chapters, whatever is left in your syllabus is 100% numerical, no theory.
Okay.
100% numerical is remaining, no, with no theory. And when we will start with numerical ones, now I will request you guys to ensure not wait for me. Not wait for me means if I have taught you IFRS, let's suppose for sure in next class we will be covering 3-4 IFRS. Let's suppose I have covered 3 IFRS. So and I have done just 6 questions. Don't do only 6. Open your book, solve more questions. No one is stopping you. Getting my point?
Okay, ma'am.
Anyone is having any other doubts? The only issue with this book I have is now when I will present you this book, this has answers below it only. That's my biggest issue with this book. I need to do something for this from tomorrow, from next class for sure. Otherwise, that will be like answered. You can definitely tell me answers by looking at it. I need to do for sure something over it. Okay. Do you want to take a break now or after questions? And it was just 1 hour's classes left. Otherwise, we will not take a break. I'm okay even with it.
We can take a break now for 15 minutes.
Okay. What about others? Otherwise, I am okay even if we don't take break. That's I am fine with it. Even if you allow me that they don't take break, I'm okay with it. Okay,
We'll
so
take
let's
a
do
break.
one thing. Let's take a break now. I will not start any new chapter. First of all, we will be doing these 3 chapters question today. Got it? And from next class, don't worry, there will be no theory, only numericals. But definitely, I need to explain you that will be in theory only. Okay, we will start continue at 10:45.
Okay.
Okay, guys, are you back? Richa, what I am going to do is I am going to make a drive, okay? And I will be sharing with you drive link today in the group. By night tonight, you can expect with me. In that drive itself, I will upload the study plan. Some of you have asked me for a study plan that I will make sure, because see what is the issue is now we are having a weekend classes, right? Not weekday classes. So what happens with this? I have make yesterday I was planning to do 3 chapters. It took 2 classes, right? So we are definitely a little bit slow. So I was when you are preparing a study plan, it should align with the classes as well. It should align with everything. So it was taking a little bit time for me to plan it. Once I am done with this, I will be creating a drive link. There I will upload a study plan as well as your BPP books, Kaplan books, everything I will upload. Whosoever wants to, whatever, you guys can follow it, so that you can you are free from all these things issues, and you can create your own folders. How you will be doing? You will be creating a folder. You will be renaming yourself with full name, either like Akshit Agarwal, Abhishek Pandey, Vinod, Vishisht. Like this, you need to rename it full name, and you will upload 2 sheets over it. One will be Excel and one will be the Word document. Got it? This is how we are going to proceed further. Okay, let's start with the objective types question. We will not be doing long questions over it because you will not get it. We will just do the theory question over it. Which three of the following are the functions of the International Accounting Standards Board? Tell me. Please don't try to look at the answer and try to come up with honest answers. From next class, I will do something so that I don't need to open this. You are unable to see the answers. But for today, you need to manage. You need to tell three. Sorry. You need to tell three. Anyone quickly write your answers in the chat box. Don't wait this much. You need to tell three, not two. Every one of you is writing just two. Come up with honest answers. Okay, let me tell you. The first one is report responsibility for all the technical matters on IFRS. Okay. Is it the function of your IFRS board? What do you think so? Yes, this is the function of your IFRS board. Your A is correct because IAA is board. Your International Accounting Standard Boards definitely has all the responsibility of all the technical matters. Second is to ensure compliance with the IFRS accounting standard. This is not IAS board responsibility. This is company responsibility. Whether they are complying with all the IFRS standards or not. This is a company's responsibility. The third is assume responsibility for appropriate financing arrangements. Assume responsibility for appropriate financing arrangement is a responsibility of company or IAS board. Definitely companies. That financing arrangement means they have a appropriate financing arrangement. They are doing the accounting treatment. This is company's responsibility, not your IAS board. Next is publication of IFRS accounting standards. Definitely that is the responsibility of IAS board. The last one is overall supervisory body of the IFRS organization. Who is overall supervisory body? IFRS Foundation, right? This is not ISB board function. The last one is final approval of interpretation by the IFRS interpretation committee. That is the responsibility of IAS board. Clear or no? The answer is ADF. Clear? The next one is which of the following is not part of the process of developing a new international financial reporting standards? Come up with the answer, try to come up. And please be honest. If not with me, with yourself at least. Absolutely correct answer, Simran. Absolutely correct, Pranav. See, the answer is B. Let me tell you that is publishing clarification of an IFRS when conflicting interpretation have developed. Why this is not a process? Because see, this is definitely feedback process, public comment, discussion paper. This is the process I have just explained yesterday. Next is, let's start with next. Okay. Which body develops IFRS? Who develops IFRS? Very good, very good, very good. IAS. No, this is not B. This is A. See, International Financial Reporting Standards Foundation is a whole committee, but developing part takes place with IASB. It's IASB. Next is okay. Next is according to the International Accounting Standard Code, in those interests of financial reporting standard issued. Tell me the answer. Absolutely correct. That's B, the public. Very good. And whosoever is sleeping now, just the classes for 30-40 minutes more. You can sleep afterwards as well. Focus over the class. Again, issue with this. I will look into it today itself. That for the next class. Okay. The ISB regulatory updates old and issue new accounting standards. Identify whether each of the following statements relating to the standard is true or false. Existing standards may be partially or completely withdrawn. True or false? It's true. Definitely, you can partially or completely withdraw it and issue a new one. Definitely, you do that. Can do that. Next one is the requirements of a new standard will be effective immediately. Yes, false. Why? Because company you definitely have a certain period of time to implement it. No can company can adopt immediately a new standard. Next is issue raised by users of existing standards are explained and clarified. Yes, it's true. The next is issues that are not covered by an existing standards. Please open your books then. You are unable to see the question. Otherwise, what will happen? You will be having an answer in front of you. I have to look after it from the next class. I will be doing something for sure. For sure, I will do something. Don't worry. Oh, you don't have book, but in this, the answer is written just below. That's an issue. Now, you will get full book by Monday. Clearly, Sandeep mentioned it in the group that everything will be available on the portal by Monday. Anyways, I will create a drive link. I will upload the book there itself. Got it? I will be creating a drive today. I will be uploading your study plan, your books, everything there. Don't worry. And you will be creating your own folder as well. Because I am not a teacher who just stood in the class and my work is done. I am the teacher who believes that if someone needs my help or someone that I should track your progress. Otherwise, no one will do something. Only hardly 10 students will pass. Then my passing rate will fall now. Next is issuers that are not covered by an existing standards are issued. That is true. See, the first one is true. The second one is false. The third one is true. The fourth one is true. Now they have given third one false, but it should be a true answer. Why? You yourselves know that if you're having any issues with the existing standard that is explained and clarified, is this true? Got it or no? I don't know why they have written false, but it's true. Clear? That might be a typing mistake.
Yes, ma'am.
Okay, next.
Yes, ma'am.
Fourth one is, okay, issues that are not covered by an existing standards are introduced. Wait a second, wait a second, wait a second. Okay. Later, the IASP regulatory. Wait a second. This was supposed to be by IASP regulatory. If any issues are raising by the users for existing standards that are clarified interpretation committee, not by IASP. That's why this is false. I forget the word IASP. That's why it is false. It responsibilities by interpretation committee, not by IASP. Clear? Now, in the fourth one, issues that are not covered by an existing standards are introduced. Now, definitely, whenever you are creating a new standards, if your existing standards is not having that issues, so what is the purpose of creating a new standards? Definitely, you can address those issues which are not covered early. Clear? Next, last question. IFRS requirement would be most relevant to the financial statements of which of the following entities? D, a limited liability partnership. Why? Come up with a good answer, good reason.
I'll just give a try to it. So, I mean, like, if you see the first option, association established by Royal Charter. So, it is not specific to any associations or any Royal Charters or any specific particular thing. And a charitable trust, IFRS is not, I mean, like, it may have a particular standards for it, accounting, but it's not a whole for a charitable trust. And the community benefit society is, and obviously, I mean, like, it's not any part of community. And a limited liability partnership is that IFRS majorly deals with the companies and the accounting policies and the frameworks which they need to follow, and they look into it. So that's the reason we take it as an option B.
Very good. Okay. Okay. Your chapter 1 MCQ ends here. Let's start with chapter 2. I am not doing long questions over it because you never get a long question. You yourself can read it. You never get over long questions over it. You just get MCQs around it. God, this book is too irritating. And for the first time, I'm facing issues like this. Okay, let's start. With no, there is no negative marking in ACC. If ACC starts negative marking, na, trust me, no one can pass. There is no negative marking in ACC. Don't worry. Okay. Which of the following is stated as an underlying assumption according to the IFRS conceptual framework for financial reporting? Absolutely correct answer, Pranav. This the everyone knows anyways. Yes, the answer is 3, that is going concern. Now, you need to tell me for every statement whether it's true or false. The first one is faithful representation means that the legal form of a transaction must be reflected in financial statement regardless of the economic substance. True or false?
Uh,
Yes,
Ma'am,
Abhishek?
false.
false,
False.
because in financial statement we haven't see I mean any legal form of transaction in the financial statement which we discussed. So I think it should be false.
Definitely, it's a false. Let me tell you. It's false, not true. Whosoever is mentioning true, they are Their answer is wrong. It's false, definitely. Why? See what happens. They are saying faithful representation means the legal form of a transaction must be reflected in financial statement regardless of the economic substance. No. Now tell me one thing. I told you in IFRS 16 itself, you are not the legal owner. Still, if you're taking any assets over the lease for next 10 years, you record it as an asset. So it's a false. The next one is only items can. Yes, it's true. Next is so it should be recorded. The next one is only items that can be depicted via a monetary item can be recognized in the statement of financial position or statement of financial performance.
It's
Yes, ma'am.
true.
True.
Okay, we have two Pranav in the class. Pranav Gupta is right. The only Pranav is wrong. It's true, not false. What? The next one you have is it may sometimes be necessary to exclude information. It may sometimes be necessary to exclude information that is relevant and reliable from financial statement because it is too difficult for some users to understand.
False.
False.
Okay, false is the answer. Who will tell me the reason? Let's discuss the reason as well.
Because ma'am, there is a concept, materiality concept, which says that all type of relevant and reliable information should be disclosed.
Correct. Who is this MK? You are not even responding. And can you please rename yourself with your full name? MK and just Zoom user. Because how will I know you are responding or no? I look after everyone in the class. I'm seeing in fact your answers, who is answering and everything. The last one is information is material. If it exceeds a quantitative threshold, any transaction does not exceed the threshold does not need to be disclosed.
False.
Uh,
Yes, Abhishek, please go ahead.
Ma'am, I'm not too sure, but I think it may be true because since the
Let's
amount is insignificant, then
Okay, let me tell you one thing. Pooja has asked me what is quantitative threshold. Quantitative threshold, I will tell you. See, for me, even five, if I am wasting 5,000 rupees, even 1,000 rupees, that matters a lot to me. I will say because that is my quantitative threshold. If a company is having 1,000, 2,000 rupees in their balance sheet, there is a variation. Does they matter to them if there is having a 4,500 crores revenue? Let's imagine a situation. For them, that is not a material amount. Correct. Any material amount means any amount that might impact. There are certain threshold. For example, it should be 5 to 10% of profit before tax. It should be half to 1% of revenue and 1 to 2% of assets. This you will study in your audit. If your amount is exceeding that, that is the material threshold for you. You will not get any amount to calculate material threshold here, but material threshold is calculated in three ways. One is 5 to 10% of profit before tax, half to 1% of revenue, and 1 to 2% of your assets. Yes, Akshit, please go ahead.
Ma'am, so if suppose ma'am any type of legal transaction has done big somehow legal case or loss which have somehow the money is less but still it is the type of particular which is somehow important is there to know the
Yeah,
stakeholder
you
that
should
yeah.
disclose it. This answer is false. That if your amount does not exceed the materiality, you should not disclose. You should disclose it because some information It's not about just materiality, it's about the disclosure also requirement, like for example legal case. Clear? Any doubts still here?
No, ma'am, no doubt.
Okay, let's do third question. Identify which of the following statements regardless of the this your regardless of the IFRS conceptual framework for financial reporting is correct or incorrect. The money measurement concept requires all assets and liability to be accounted for all the original historical cost. Which a wrong answer. Vinod, wrong answer. Umair, wrong answer. Others, you can assume your answers to be correct. The answer is false, and the reason is very clear that you know one thing, all the cost, historical cost is not only conversion that requires money measurement. Got it? The next one is faithful representation means that the commercial effect of a transaction should be reflected in the financial statements, not necessarily its legal form. Now, above it was something different point. Now it's something different points. Let's see if you guys can make a comparison. Kanika Siddhi, absolutely correct. Hardik, correct. Varsha, correct. Jayanti, Umair. Ritika, you are wrong. Brindu, you are also wrong. Pricha, you are wrong. Aishwarya, you are wrong. Zoom user, please rename yourself. I'm telling you, you are also wrong. Now the answer is true. Earlier, what was the case? Not only legal form, if you are able to get the economic benefits over it, you can record it. Yes, it's true. The next is the concept of materiality considers only the decisions that primary users may take based on the financial information about the specific reporting entity. It's true or false? Let me see. Umair, your answer is wrong. Others can assume yourself correct. Siddhi, your answer is wrong. Manu, your answer is wrong. Rati, your answer is also wrong. Pranav, wrong answer. The answer is correct. Why it's correct? I am talking about third first. Akshat, please listen, then I will explain you first point again. The concept of materiality considers only the decision that primary users may take based on the financial information about the specific reporting entity. It's correct. Now see what happens. Materiality information. Materiality information means any information that is way material for your company. Let's suppose even though your company's company is profitable, but your a very big legal case is going on. Okay. Now legal case that might not be material by amount, but by nature, that legal case is going on by which your company's goodwill is getting affected. If goodwill is getting affected, for sure it will impact on your company. Yes or no? So again, that will become a material thing. So it will definitely impact the users of the financial statement. The next thing, the first point I am repeating again for Akshat. The money measurement concept requires all assets and liability to be accounting for its original cost. Original means historical cost. No money measurement concept don't have just historical cost. You have fair value also. You have value in use also. You have current cost method also. Got it? Any doubts till here? In third point, they are saying that the concept of materiality only consider the decision based on the financial information. No, it's not about just financial performance. It's about other thing also. Let's suppose also your company's finances are very good. But one court case is going on that by nature, not by financial, by nature that is impacting your company a lot. If as an investor I ask you to invest in it, will you invest it? Or you definitely not impact in it na. It's not about just you, in audit you have two things that materiality is not only about the amount, it is by the nature also. Is it a related party transaction, then also it is a material. Related party transaction means, let's suppose I am a director of a company and I am making any personal transaction within the company, then it also will be material. These things are clear. Now let's think. Yes, Akshita, I can repeat definitely second. See, in a second, what was happening? Faithful representation means the commercial effect of a transaction should be reflected in the financial statement, not necessarily its legal form. We have discussed that it doesn't matter if you have a legal form over it or no. If you are able to get the economic benefits from it, you can, yes, you can record that in your financial statements. I gave you example in the form of leases. Let's suppose you are doing a leases. Okay, in leases for next 5 years. In leases, ultimately asset is not yours, but for next 5 years you are going to use the asset. What you can do, you will be showcase that asset in the non-current assets in your balance sheet, and over the 5 years you will charge the depreciation over it. That's why you can reflect it in the financial statement. Got it? Okay.
Ma'am,
IFRS, yeah.
You had said that this third one is incorrect, that because any type of legal cases can be there, and here it is written correct.
Because that was a different thing. Yeah, that is a different thing. You need to make a comparison. Okay, next. IFRS 13 historical cost is no, IFRS 13 fair value measurement set out a fair value hierarchy that categorize input into three levels. Yes, there are three levels. Which of the following inputs will have the highest authority? Everyone know this. Active market. C. Now fifth question. The IFRS conceptual framework for financial reporting identifies qualitative characteristics of financial statements. Which two of the following characteristics are fundamental qualitative characteristics according to the IFRS conceptual framework for financial reporting? Two option you need to tell. Very good, Emir. Absolutely correct answer. Brindu 2. Kanika wrong. Mayuri, first one is correct, second is wrong. Prithvi is correct. Pranav, first is correct, second one is wrong. Amandeep correct. Hardik correct. Vinod correct. Simran second option is wrong. Aryan correct. Vandana's second option is wrong. Pranav Gupta first one is correct. Second is wrong. Varsha is correct. Varsha H is correct. The answer is relevance and faithful representation. A and C. These are the main. Yes or no?
Yes.
The next, let's start. Okay, this is a numerical one. On 31st December 2023, Braxy sold $1 lakh of trade receivables to the factoring company for $90,000. If the factory has not collected the debt by 28 February 2014, they can return the debt to Braxy. What is the current asset for trade receivables in Braxy's statement of financial position as at 31st December 2023? Now let's see who can tell me this answer.
Ma'am, may I?
Yeah, please go ahead, actually.
So, ma'am, here we can see that as the it has sold by trade as it is sold by 1 lakh 1 lakh dollar. So we make entry of 1 lakh dollar,
Just tell
and
me whether it will be 1 lakh or $90,000. If so, it's 1 lakh, then what is the reason? And it's 90,000, then what is the reason? And first tell me the answer. If your answer will be correct, then I will allow you to proceed.
ma'am, 90,000.
No, wrong answer. The answer is 1 lakh. Anybody would like to give me the reason behind 1 lakh? Not 90,000. 10,000 is not discount. See, read the question again. Brexit sold $1 lakh of trade receivable to a factoring company for $90,000. If the factor has not to the factoring company means, you know what? Do you know what is factoring company? They collect trade receivables on behalf of you and they pay you immediately on the current date. Now, if the factor has not collected the debt by 28 February 2014, they can return the debt to Brexit. Correct. What is the current asset for trade receivable in Brexit statement of financial position as of 31st December 2013? That will be 1 lakh only. Why? Because there is a risk involved here. Factoring company has clearly mentioned if they are unable to collect the debt by 28th February, they will return it to Brexit. So who is the one who is bearing the risk and reward? Risk of default. If your trade receivables tomorrow is unable to pay, then Brexit will bear it, not your factor company.
So ma'am,
Got
1
it?
lakh is the answer.
Correct.
And ma'am, if suppose ma'am factoring company bear the loss, then 90,000.
Yes.
Okay, ma'am.
Yes, if factor company bear the loss, then it will be, you can record it 90,000. No, now they have denied to bear the loss. What the hell is this again? Now next, recognition is the process of capturing for inclusion in the financial statements or items which meet the definition of an element in the IFRS conceptual framework for financial reporting. Which one? Which of the following items should be recognized as an asset in the statement of financial position of a company? Simran, Vinod, Prithvi, you three are correct. Umair, absolutely correct. Pranav, correct. Brindu, correct. Amandeep, correct. Aishwarya, wrong. Rati, correct. Varsha, wrong. S. Varsha, wrong. Jugal, correct. Jugal, wrong. Mayuri, correct. Zoom user is Mayank. Okay. That's C and D. What you have mentioned, can I know it? Jayant, it's correct. Sorry, wrong. The answer is D, a receivable from a customer which has been sold. Factor to a finance company. The finance company has full resource to the company for any losses. This is the answer. As your receivables are sold, correct. If receivables are sold, that means Definitely, that will be represented as an assets in the financial statement. Now, if you look at your answer, option A skilled and efficient workforce which has been very expensive to train. Some of these staffs are still in the employment of the company. Definitely, that is never. Definitely, employees are asset of your company, but you never present them in the financial position. Do you present them in the financial statement? I am talking about financial position assets. No. The next thing is a highly lucrative contract signed during the year which is due to commence shortly after the year end. Okay. Vinod has we don't value the employee, but that's the sad reality of corporate, let me tell you. 90% where you will not find the values, but ultimately money matters. Whosoever says na money does not matter to me, let me tell you that person is either freaking rich, okay, or that don't have the very good financial goals in their life. For example, they don't want to travel abroad or something like that. Otherwise, money does matter whenever you are working somewhere. So whosoever says on a LinkedIn ever, you will find a person mentioning you are getting a package of 30 lakhs with a good working environment, and somewhere 60 lakhs with a bad working environment. I will go ahead with 60 lakh with a bad working environment. So definitely money matters a lot. So whosoever says it, for some people it might not, but ultimately it matters. So
Ma'am,
next is
will
the
you,
high. Yes, Akshay.
explain again the seventh question, what it's saying?
They are saying which of the following items should be recognized as an asset in the financial statement. Which out of four options, which is an asset for a company? Option A is definitely you don't record your employees in the financial statements. The second one is a highly lucrative contract signed during the year, which is due to commence shortly after the year, and definitely you will not do it. You have just signed a contract.
But ma'am, suppose ma'am, in option A, we mentioned that employee pension scheme, employee benefit scheme. So what is it there?
No, that comes in other comprehensive income, not in financial position. They have
Oh,
clearly mentioned financial position. Financial position means balance sheet.
so in balance sheet, employee benefit expenses and employee benefit employees sorry employee pension like they are now
That
employee
comes in
related.
liability side, not an asset side.
Yeah, sorry, huh? Liability side, okay.
Next is a highly lucrative contract signed during the year, which is due to commence shortly after the year end. A highly lucrative contract signed during the year. You have just currently signed a contract. You will come in shortly after the year end. Definitely, that is going to generate a revenue for you, but you cannot record it as an asset. Next is a government grant relating to the purchase of an item of plant several years ago, which has a remaining life of 4 years ago. Now you have received a government grant related to the purchase of a plant several years ago. Why several years ago? What does this mean?
That ma'am, the transaction has done in a previous year, and this transaction is not done in now. Means in this not year, in financial year, current financial year.
Still, you might be already recording it as an, and you know one thing, government grant. If you have received any grant and for any particular reasons, and you are not utilizing it for the same reason, government can ask you to return the grant as well. You have a IAS over it. We will be studying that.
Okay.
Okay. The last one is a receivable from a customer which has been sold. You have a receivable. Receivable is ultimately your asset only. Even if you have sold to a finance company, still you will be having a asset over it. That's a trade receivables for you. Let's proceed very, very quickly like this, so we will not be able to even cover the syllabus. Which two of the followings are required to meet the comparability characteristic of useful financial information? Two of the following are required. Comparability. Comparability is the characteristic. On the basis of that, tell me. 2. You need to tell 2. Whosoever will be the exact correct, I will mention their name. Otherwise, you guys can assume yourself wrong. Everyone can assume yourself wrong. Simran, you are correct. Akshat, you are correct. Prithvi, you are correct. Others start assuming yourself wrong. The answer is A and B. The first one is saying ethics are required to disclose their accounting entities are required to disclose their accounting policies. Yes, it is true. Second is corresponding information is required to be provided in the financial statement. Corresponding policies means corresponding information means any information about legal cases, contingent liabilities, contingent assets. These things are required to be disclosed. Next is entities must use the same accounting policies from period to period. This is consistency principle, not comparability. All assets within a class should be depreciated at the same rate. It is again a consistency principle. Got it? Comparability, not consistency. Clear? Any doubts? Okay, so guys, I would like to say one thing to you before wrapping up today's class. The first thing that I wanted to mention is definitely your chapter 1. I can say chapter 1, 2, 3 are completed. You will receive your VGLD book soon. So can you please do one thing? Can you go ahead yourself with these questions and I can start with the theory numerical topics from the next week?
For sure. Yes.
You can definitely
Yes,
go
you
ahead.
can.
Correct. Because from next week, and see, I will tell you one thing. I will be creating drive for sure today itself. I'm just asking you to before to next class, make sure you are making your folder and adding one Excel and one doc, so that whenever we are doing questions you can do simultaneously with me in the class. And when I say simultaneously with me in the class, doesn't means I will wait for you 30 minutes to even do a simple calculation. Like this we will not be able to complete. You do with me simultaneously, I will wait 30 seconds after every step. That makes sense. But waiting 5 minutes after every step will not make a sense. You yourself know, looking at the strength and everything of the class. And many of you are not joining the class. It's above 65 strength of the class. So just imagine, otherwise you will not be able to complete a single question in a day. Got it?
Yes.
So I just want one thing from everyone, to just do these numerical question, theoretical question, and in case of doubt, definitely I'm there to solve. Okay then, bye guys. Have a nice day.